Hello everyone, this is Bhavik Chokshi here and welcome to the 2020-23 SFM Fast Track Batch. Now, in this updated course, we are going to cover everything in as is done in the regular batch. However, we would be doing it at a slightly faster pace and we would also be sharing you the solutions. So, I will be solving every question on the board and the board notes will also be shared and your material which will comprise of the SFM shield where we have the concepts and it will have separate volumes of chapters where you have questions and answers one by one. So let's get started. So we'll just do a very quick roundup about the importance of the chapter wise ABC level importance in the topics of SFM and also a brief background about myself. So I have been teaching SFM for the last, I think, more than a decade, and in my past experience, I've been working in the investment banking profiles of Morgan Stanley and JM Financial. I've also completed my CFA level, all the three levels, your CS and CA with a rank in my CA final. I personally love swimming a lot and I do a lot of open water swimming races. So that's something about myself, but going to the more important part where you're more interested in the SFM. So over here, this is paper 2 of your CA final syllabus, and in terms of the scoring nature, this is one of the most scoring papers and one of the most interesting papers as well. So we have a 120 mark paper with 20 marks coming as options. Question 1 goes in as compulsory like your standard question papers, and among the remaining 5 questions, there would be any 4 that you need to attempt. Now, in every question, the institute asks you a theory question of approximately 4 or 5 marks each. So, your total weightage of core theory topics is around 20 odd marks in your paper, and the remaining 80 marks will comprise of practical topics. Now, these practical topics, if you go to see over here, are broadly subdivided into 10 main categories of chapters, where you have valuation of securities, mergers and acquisitions together forming one set, portfolio, mutual funds and risk management forming another set, foreign exchange along with currency options forming the third set, and then you have derivatives and interest rate forming the fourth set. So I would subdivide the practical topics into these 4 sets, each of them being of an almost equal importance. Unlike your paper 1 where you have a lot of chapters and hence there are possibilities where you don't get questions from every chapter, in your paper 2 usually the institute almost always asks you questions from each of these chapters. So when you look at valuation and mergers, both of these being important topics, your total weightage, so your weightage from valuation will be around 10 to 15 marks. Again, mergers would be around 10 to 15 marks each. So both of these would come for 10 to 15 marks. Now, valuation is the first chapter that we will do, and it's a very varied chapters in terms of there are close to 3 to 4 individual chapters which I could easily put across in this chapter. So you would have valuation of fixed income securities, valuation of equity securities, valuation of some other complex instruments like convertibles, maybe rights, warrants, money market instruments. So a lot of this is put inside the valuation of securities chapter. Institute calls this by the name of security valuation and security analysis. As mergers and acquisition, this is a relatively simpler chapter, I would say, and it is among the important chapters, I would say, one of the most scoring chapters. Portfolio management is one of the institute's favorite chapters. Again, if you say on an average around 10 to 15 marks, mutual funds would come for around 5 to 10 marks. Mutual funds is kind of an extension of portfolio, so you typically do this after portfolio. Risk management, not very important. Maybe if it comes for around 2 to 4 marks, which is on value at risk. Typically, there's a concept called as VAR, value at risk, on which the institute typically asks question. Corporate valuation and allied is also a very general topic, which is kind of maybe different techniques of valuation other than your standard valuation technique using discounted cash flow. Foreign exchange and international financial management, both of these are, I would say foreign exchange is extremely important. You might get a question also on international financial management. Foreign exchange, I would put 15 to 20 marks on an average, and hence it is, I would rate the most important topic in your entire syllabus. International financial management, it depends, sometimes it comes, so it may come for 0 to 10 marks. And so this is international financial management is very similar to international capital budgeting. Derivatives analysis and valuation, again around 10 to 15 marks, and interest rates around 5 to 10 marks. So when we are looking at these topics, typically this is your broad chapter wise weightage, and obviously there are 80 marks that you will have to attempt, and there will be around 15 to 20 marks of practicals which will come as optional, and there would be another 20 marks that will come for theory. So this is your broad weightage. So what do we start today? Without doing a lot of back and forth, we will start with the valuation of securities. So within valuation of securities, what do you mean by securities? What are covered within the heading of securities? We will say bonds, that is fixed income instruments. Now you can always say debentures, deposits, all of these are fixed income instruments. You have equity shares where you get a variable return, like you get dividend, which might vary. So and again this might go on till perpetuity, and hence it is valued using a different valuation model. Then you have valuation for, let us say, certain complex instruments and certain special cases like convertibles, right shares in case of buyback, and money market instruments as well, which are very short-term instruments having a less than 1 year time frame. Okay, so over here we will first focus on the valuation of bonds, which I would say is in a way one of the most difficult things in this entire chapter. So you will start this chapter with the valuation of bonds, and just to give you perspective on the valuation of bonds, CFA level 1, for example, has one full subject for fixed income. Institute has just dedicated one chapter, and within that a sub part of that chapter for valuation of bonds, and it has tried to put in a lot of concepts over here. So yes, we'll start with the valuation of bonds. However, valuation of bonds does not have any significant interlinkage with any other section in your syllabus. Then you go to valuation of equity, which is slightly more easier and has a lot more interlinkage with the other parts of syllabus. So we kind of deal with the bonds first, which is interesting, challenging, and slightly difficult as well, but I'm sure you will enjoy. And then we go on to the valuation of equities, which will have application in mergers and acquisition, in portfolio, at various places. So let's start with valuation of bonds. Now, when we look at the valuation of bonds, or valuation of fixed income securities, what all gets covered within the larger heading of fixed income securities? You will have something like debentures, you will have something like bonds, you will have government securities, deposits, etc. All of these are covered within the larger universe of a fixed income security. So how will you value a fixed income security? Let us say there is a government bond which is available in the market. Let us say there is a government bond, a government security which is available in the market. Over here, the face value of this security is 10,000. Sir, what is the significance of face value? This is the value which is used by the company or the government, for example, to give coupon, because different people might buy it at different prices. So we would say that, well, we will return back usually the principal, which is the face value, and we will also give the coupon at a standardized base, which is a face value, which is, let us say, 10,000. Usually, unless given otherwise, the face value also equals to the redemption value. So if nothing is given, 10,000, which is the face value, will also be the redemption value. Let us say the coupon rate over here. What is the coupon rate? Coupon rate is the rate of interest that the bond pays. So let us say the coupon rate over here, for example, is 7%. So this is the coupon rate, and the term of this bond, for example, is 5 years. Now you want to figure out how much should you as an investor ideally pay for this bond. So this is a government security which is available in the market. Let's say GSEC, or a government security which is available in the market. As an investor, you want to figure out how much will you pay for this bond. A core principle of finance is that the value of an asset is considered to be the present value of its future cash flows. I will again repeat, a core principle of finance is the value of an asset is considered to be the present value of their future cash flow. So what is the future cash flow in case of a bond? Well, in case of a bond over here, the future cash flows will comprise of coupons. So over here, 700 of coupon in year 1, 700 in year 2, 700 in year 3, 700 in year 4, and 700 in year 5. Is that it? These are the coupon payments. Apart from that, you can also receive the principal payment. So over here, let us say 10,000 is the value of the principal. So over here, you will get the coupons of 700 each, and you will also get the principal value of, let us say, 10,000. So the value of a bond is considered to be the present value of all of these future payments of 700 each as well as 10,000. And hence, this will be the value of a bond. So we will try to find, let us say, years 1, 2, 3, 4, and 5. We will say that the cash inflows that an investor, CI, that will get from a bond is 700 in the first year, 700 in the second year, 700 in the third year, 700 in the fourth year, and then let us say 700 of coupon plus 10,000 of the principal back. These bonds are called as bullet bonds. Bullet bonds means they will give the principal back at one shot at the end, let us say at the end of the 5th year. So this is, let us say, 10,700. अच्छा, so अपन क्या करेंगे? Well, we will total this up and we will say that okay, this is 13,500. So we will say that we are going to pay 13,500 because the cash inflow that I'm going to get is 13,500. Is that right? No, if someone promises to pay you 10,000 after 5 years, are you going to give that person 10,000 today? No. So how much should you give? Well, unfortunately, this is not a complete piece of information for valuation of bonds. So what we also need over here typically is the investor's required rate of return. How much does the investor require on the bond? So what do you guys think should be the required rate of return? Sir, can it be the WACC, weighted average cost of capital? We do that in capital budgeting. Should it be the cost of equity, KE, that we find? Sir, remember the required rate of return will be usually the opportunity cost, which means if not this investment, some other investment. But it has to be an apple to apple comparable, which means if not this government bond, then let us say some other government bond. However, I don't expect to get, let's say, the cost of equity or the WACC from government bonds. The cost of equity is the required rate of return on an equity investment. Equity investment inherently has a lot higher risk as compared to a bond investment, and hence the value of a bond over here should be calculated as the present value of future cash flows. But while finding the present value, while doing the discounting process, you need to find the required rate of return. Usually when you do capital budgeting, you are looking at a project which you are investing in a business, and you will say that how much should this project ideally give me? What is the minimum required rate of return? If I don't invest it in this project and invest it in some other project, which is also a risky project, how much is the required rate of return? In a similar way over here, if I don't invest in this bond, on the contrary, if I put my money in some other bond, how much would that give me? It is similar to a cost of debt. So over here, the question in a lot of cases will give you something like the market rate of interest. Let us say on similar instruments, a market rate of interest today is 10%. Sir, how does market rate of interest be derived? For example, when you look at RBI changes its, let us say, market rates. It increases, you might have heard sometime, the repo rate by something called as 50 basis points. What is basis points? Well, remember 100 basis points, we will study that further, is 1%. So when we say RBI increases the rate of interest by 50 basis points, that is 0.5%. 100 basis points is 1%, so 50 basis points will be 0.5%. Okay. So for the time being, let us say in the market, if I don't invest in this bond and if I invest in some other bond, the market rate of interest, for example, is 10%. In which case I will say that if I have to put my money in this bond, I better get 10%. If I'm not getting 10%, why should I even touch this bond? I'll put my money in some other bond. And hence, I need to find the present value. Now, the question is, I'll just do the absolute basics. In all likelihood, you would be aware, but nevertheless, over here, we'll do it to the extent required. If I want to find the present value, how will I find the present value? Well, the present value over here can be done by kind of inverting the process of compounding. Like if you look at compound interest, the formula is amount equals to the principal plus 1 plus r into n. So the amount is the amount that you get in the future, so this is the future value. The principal amount is the amount today, so that is the present value, into 1 plus r raised to n. So we are trying to say that 100 rupees today is going to become how much after 4 years? But we don't want to find, we know that after 4 years the value is 700, we know after 5 years the value is 10,700, we know after 3 years the value is 700. We want to find the value today, in which case what you will do is you will just rearrange these terms and you will say, okay, so the present value will equal to the future value upon 1 plus r raised to n, that is present value equals to the future value into 1 upon 1 plus r raised to n, and this is called as a discounting factor. So over here, this is called as what you call as a discounting factor, which you do flawlessly. 1 divided by 1.10 equals to, right? If you remember, this is a discounting factor. Sir, what is a discounting factor? It is nothing but the inverse of the compounding factor. Compounding is a process which takes you from today's value to a future value, whereas discounting is a process which takes you from the future value to today's value. Like if someone says 700 after 4 years, worth how much today? 700 after 2 years, worth how much today? You will use discounting. However, if you have a value today and you want to find out how much will it be worth after 5 years or 4 years, that is a process of compounding. So over here, you want to find the value of a bond which is not the total cash flows. You have to invest today. So the value of the bond today will be the present value of the future cash flows. And let us say here you are doing evaluation from an investor's perspective. So the investor says that, well, you know what, whatever the market price is, whatever the company is offering, I don't care. What do I require? I require a 10% return, which means on your calculators, you will take 1 divided by 1.1. So that is 0.90909. So here the question arises, how many decimals should you take? Ideally try to take 4 decimals. That is the safest, and you round off the 4th number, which means if the number is 5 or above, then like this is 90909, which means you will round off the 4th number and call this as 9091. Some places institute also takes 3 decimals, some places it also takes 2 decimals, but 4 is the safest. So over here, this is 0.8264. Sir, how are we calculating it? You just press the equal to sign, 1 divided by 1.1, then equals to, then again equals to, equals to, equals to. So this is just basics for someone who has probably forgotten, but otherwise I think you should be fairly clear on these numbers, and then you find the present value. So how much is the present value? Well, 700 into 0.9091, press M plus, so that goes into memory, 636.37. Then 700 into 0.8264, again M plus, this is 578.48. Sir, what do these numbers imply? It implies that if someone is promising me to pay 700 after 2 years, against that 700, how much should I be investing today? Sir, I should be investing 578 today, and if I invest 578 today and wait for 2 years and I get 700, that is implicitly getting a 10% return. Similarly, over here 700 into 0.7513 M plus, this is 525.91, 700 into 0.6830, over here 478.1. Even if you don't write the decimals, I mean, preferably rupee value you keep up to 2 decimals, but even if you don't write it, it is fine, because at the end of the day, everything is going in the memory. So when you press M plus, everything goes into the memory. So this is 10,700 into 0.6209. So I'm starting from the basics. Remember, there are faster ways to do it as well, but first step by step working. So this is 6,643.63, and hence, so what do these numbers signify? Again, if someone comes and tells me, sir, you know what, I'll pay you 10,700 after 5 years, please give me an X amount today, I will say, okay, if I need to generate a 10% return, how much should I give? Well, I should give 6,643.63. if I give that today and the other party gives me 10,700 after 5 years, that means on the 6,643, I would have generated a 10% return. This is not just for 1 year. I need to ensure that I get an overall return of 10% in each of the years, and as a result, over here, if I take the total, so I press the MRC, memory recall, I will get 8862.49. This is what I call as the present value. The value of any asset in the world of finance, whether it is equity share, whether it is a bond, whether it is a capital budgeting project or anything, a value of any asset in the world of finance, among other things, can theoretically be calculated as the present value of future cash flows. This technique is called as a discounted cash flow technique. So over here, by discounting future cash flows at the required rate of return that an investor requires, you have found the value of a bond. So over here, when we look at the formula over here, so when we look at the fixed income securities section, we are just focusing on the first part over here, which is valuation. So we are focusing on this valuation part. So we are seeing various types of bonds we will see, and we will see how do we value these bonds. So in case of a regular bond, in case of a semi-annual bond, and in case of a perpetual bond. For the timing, we are looking at a regular bond over here. So valuation of a bond, as per the discounted cash flow technique, the value of a bond will be the present value of the coupons, that is the interest, and the redemption value. Perfect. The value of a bond from an investor's perspective. So let us say your client is an investor who wants you to give a recommendation on the value that the investor should be paying, can be calculated as follows. Interest upon 1 plus KD plus interest of the second year upon 1 plus KD square plus interest of the third year. Sir, what is it written? Well, what I've written in a tabular manner over here is written in a formula way. So over here, it is like saying that you have done the value of a bond today is 700 interest of the first year upon 1 plus 0.1 raised to 1 plus 700 of the second year upon 1 plus 0.1 raised to 2, and so on till you reach the last year, where you have 10,700 interest and the redemption value, both of them together, upon 1 plus 0.10 raised to 5. So rather than writing this in a horizontal format, we have written this on a vertical format, and as a result that will give you the value of a bond. This can be said to be the intrinsic value of the bond. What do you mean by intrinsic value? The real value based on its financial fundamental factors, the real value of the bond based on the fundamental factors. I'm not looking at everything, any other thing. I'm looking at core financial fundamental factors and finding the intrinsic value. In a fair market, in an efficient market, the market price will also be equal to the intrinsic value. So sometimes institute uses the words find the fair price. Sometimes they say find the intrinsic value. Sometimes they say find the market value. Usually these terms are used interchangeably because ideally in a fair market, the intrinsic value will be equal to the market price. Like for example, in your inter-C, if you remember, you used to use sometimes a Gordon's formula to find the price of a share. That is the price of the share based on the fundamentals, the dividend, the cost of equity, the growth, if you remember. If not, we will do that in some time. That is the intrinsic value. If nothing is available in the market, the price will be the same as intrinsic value. However, if the question is specifically given to be a market price which is different than the intrinsic value, then it might be different. But in a fair market, unless given otherwise, the intrinsic value and the market price can be considered to be the same. So sir, what is B0? B0 is the value of the bond today. So this is the intrinsic value that you should be paying in today's term. 0 is year 0 today. N refers to the number of years, and KD refers to the required rate of return from the debt securities. That is a discounting factor. How much return that you intend to earn. Let us say this is 10% over here. Okay, so over here we have taken the recap, as we said, for the concept of time value of money, where in general this is a formula for compounding. Compounding takes us from the present value to the future value, whereas discounting takes us from the future value to the present value. This is something that you must have done in your inter-CA or even your CA foundation. So future value into 1 upon 1 plus r raised to n is the present value, where 1 upon 1 plus r raised to n refers to the discounting factor. Okay. So what we will do is, we will, before going to the key points, we will try to address a very basic problem. Question number 2. Try to understand it in deep. So abhi to apan ne sirf basic valuation principles liye, we try to apply those principles in question number 2, and we will arrive at a number, then we will do some dissection, some post-mortem of that number, try to get some conceptual knowledge, and then proceed into the further things. Okay, so on your shield, I guess, on your notes, I guess you will go to question number 2. This is page 1. Chalo, nariyal todta ho jai shuru. Go to question number 2. Is willing to purchase a 5-year 1000 rupee par value. Achha, so this is your term, 5 years, par value is the face. This is your term. You can even summarize those important points of a bond separately. Having a coupon rate of 7%, 9%. So this is a coupon of 9%. Okay. A's required rate of return is 10%. So this can be taken as a discounting factor. This is your required rate of return, 10%. How much should A pay to purchase the bond if it matures at par? Okay, on the next page solution will be given, but we will do it independently as well. So when you look at this question, question number 2, we will say how much will you find as the value of the bond? Well, the value of the bond is the present value of future cash flows. This is a bond which seems to have 5 years in term, and if I look at the cash inflow, the bond is going to give me, if I invest in this bond, a coupon rate of 9%, and unless given, coupon is always a percentage of par value or face value. So 9% of 1000. Again, coupon is more like a legacy term. In the older days, there would be a bond and physical bond. Along with that, there will be 5 coupons, and the person who wants to collect interest before electronic system, before demat, etc., would go with the coupon and against that get the interest. So it's like a legacy term which is still continuing over here. 1000 into 9% will be coming to 90. Second year also 90, third year also 90, fourth year also 90, and in the last year this is 1000 plus 90, which is 1090. Okay, so can I take the total value to be the total of all of these? No, that is ignoring time value. You also have to consider a discount factor, and the discount factor over here is A's required rate of return, which is 10%. So A requires 10%. So how much should A invest such that he will get a 10% return? Okay, so you will take 1 divided by 1.1 equals to, again, 0.9091 equals to 0.8264 equals to 0.7513 equals to 0.6830 equals to 0.6209, and then you will find the present value. I will not write these present values again in the interest of time, and it is just a calculative thing. So if you do the calculation, it is 90 into 0.9091 m plus, I think, 81.82, then again 90 into 0.8264, 74.37, 90 into 0.7513, 90 into 0.6830, and 1090 into 0.6209. Perfect. If you total up, this comes to around 962.06. So this is the present value. The question tells you how much should be A willing to pay to purchase a bond. We will say he should be, in today's terms, willing to pay 962.06 if he has to purchase the bond and ensure that he gets a 10% return. Okay, so this is the value of a bond. From an exam perspective, this is sufficient. However, we need to understand a few more things and a few shortcuts before we proceed further. First of all, what is the face value in this question? This is just for your conceptual knowledge. If you understand it, excellent, but this thing that I'm going to discuss will come from practice, not directly. So if I look at the face value over here is how much? 1000 of this instrument. Acha, what is, let us say, the market price or the intrinsic value of this bond, which is approximately 962, which means the face value is greater than the market price. Basically, the market price is lower, and hence this bond is trading at a discount to the face value. Sir, why would this bond be trading at a discount? We will say, how does it matter? We want 3 marks, 4 marks for this question. We get and we proceed. The institute will not ask you. But is it a sheer coincidence that this bond is trading at a discount over here? Well, not necessarily. If you apply your basic common sense, you would say that, well, you know what, if the coupon rate on this bond is 9 and everyone in the market gives me a 10% return, if I invest the entire face value, I will get just the coupon, that is a 9% return. Now, the entire market is giving a 10%, so I can't force the issuer to give me 10%. However, I can tell the seller of the bond right now that, well, you know what, if I invest the entire 1000 rupees, I'm going to get only 9%. But I need to fetch a 10% return, and as a result, I will buy this bond at a discount. And hence, my return will be formed in the form of, let us say, coupon plus some capital appreciation, which together will fetch me a 10% return. And hence, because over here, the market rate of interest, we can also say that this is like the discount factor as compared to the coupon rate. Okay, we can write it in any order, but let us say if I write the coupon rate first and the market rate of interest later, I can write it in any order. As the coupon rate is less than the market rate of interest, which is also the discounting factor, the required rate of return, so you can say market rate of interest or the required return, whatever it is, basically the discounting factor. In which case, I would say that, well, this is kind of an inferior bond, right? Ideally, if everyone is giving me 10%, your bond should also give me 10%. It is not giving me 10%, and hence I'm not going to even pay, forget the premium, I'm not even going to give the face value. I will give you lesser than the face value, and hence this bond will always trade at a discount. Sir, this is fundamentally like, I mean, I'll just go the other way around as well. Like if the face value, for example, was 1000 and the market price, for example, came to, let us say, a higher value, for example, 1050, the market price is higher, in which case this is a bond which is at a premium. Now, usually such bonds are at a premium if they are superior bonds, which means they give you a coupon rate which is actually higher than their required rate of return. They require, for example, only 9%, they require 10%. But this bond is giving me a coupon, for example, of 11%. So this is kind of a superior bond. where the coupon is greater than what is required. So over here, as compared to the required rate or as compared to the market rate of interest, which is usually the discounting factor, you're getting more, and hence this bond kind of trades, let us say, at a premium. तो यहाँ पे अगर और कोई पॉसिबिलिटी भी देखना होगा तो कैसे इवेल्युएट करेंगे? तो लास्ट पॉसिबिलिटी यहाँ पे ये है कि आपका जो फेस वैल्यू है, लेट अस से ये 1000 का है, आगे का भी केस आप वापस से एक बार रिव्यू कर सकते हो, एंड आपका मार्केट प्राइस भी 1000 का है, दैट मीन्स फेस वैल्यू इज इक्वल टू द मार्केट प्राइस. ये आपका हो सकता है पार वैल्यू बॉन्ड. सो ये है आपके बॉन्ड्स विच इज at the par value. Now when we are looking at these bonds which are at the par value, over here what should be the relationship between your coupon rate and the market rate of interest or the required rate? So if you look at the required rate of return or the market rate of interest, which is a discounting factor, what should be the return? This is like a par value bond, or I would say it's like a normal bond where you want, let us say, 10% return. The bond's coupon is 10%, so you will say, perfect, I don't need anything else. I'm not going to ask for a discount. I'm not even going to pay you a premium. It's a 1000 rupee instrument. I'll pay you 1000 rupees. So these two are equal. So over here, most of the times, you will never be asked any of this evaluation. Never. It is just for your understanding. Sir, what understanding over here? Cross-checking. Unlike FR, where you can look at the balance sheet tallying and say, okay, my double entries have gone right. Here, you don't have that luxury. So even before you start this question, even before you start question number 2, you can look at the coupon rate of question 2. Coupon rate of question number 2 was, I think, 9% with the discount factor, which was 10%. In which case, even by merely observing the two, you can say that ideally your answer should be, if the face value is 1000, then your answer should be less than 1000. This is for cross checking. Okay, this is just a tip for cross checking. It is not necessarily something that you have to kind of do in the papers. However, if you do enough practice, you will be able to ask yourself, okay, by mere observation, you will say, okay, this is a coupon rate which is lower than the market rate, your answer should be less than 1000. So if you do some calculation mistake and you see your answer to be greater than 1000, you know that somewhere you have probably gone wrong. So this is a general rule. Again, this really helps you. The last one is what institute sometimes uses even in a bigger problem. Like, the question does not tell you the discount rate. The question does not tell you the discount rate. However, it tells you that there is a bond whose face value is equal to the market price. So if the face value is equal to the market price, we can imply that the coupon rate will be similar to the discount rate. So if the question, even if it remains silent, then we can imply that the coupon rate will be equal to the discount rate in case the face value is equal to the market price. This piece of information can be used even in certain questions. We will come to that. Right now, you just have to build your concepts. Achha sir, so if we kind of review the rationale, we would say that, okay, if the market price is lower, that is a bond is at a discount, typically that will be, if it's an inferior bond, that is, it is giving you a coupon which is less than the market rate of interest. And if you remember, when you see zero coupon bonds, they give you zero coupon and they are usually at a huge discount. Sir, can you show us mathematically why that should be the case? Well, over here, if you start at 100 rupees, for example, and the bond gives you only 9%, which means at the end of the year, this 100 will become 109, for example. However, if your required rate of return is 10%, which means you will do 109 divided by 1.10 discounting, so you will come to 99. And hence, as you can see, the value is lower. Listen to this carefully. Mathematically, if my coupon rate is a rate that I'm going to get in the future, is 9%, that means after 1 year, probably, if it's a 1 year fixed deposit, I'll get 109. Face value may be 100, I will get 109. However, if I require 10%, then in today's terms, I should invest 99, which is basically lower than 100. On the other hand, if I start at 100 and the coupon rate is 11%, so I'll get 111. However, if I look at discounting this at the rate of 10%, this is 111 divided by 1.1, that comes to approximately 101 or 100.9 as the case may be. So this is 101, and hence we are saying this is a bond for which I should pay a premium. So if I merely require 10%, but the instrument is giving me 11%, I'm ready to pay a premium. But if I require 10 and the instrument is going to give me 9, I will need a discount. Okay, so mathematically this is something that should apply. So we have explained this in the shield as well, for which we will practice this valuation. You can find the 962 very easily. However, to understand why should it be lower than 1000, why should it be more than 1000, will need some bit of practice. It will not come naturally. Achha, like over here, this is 962.07. Okay, and A should pay a maximum of 962 for the bond. Okay, so this is extra knowledge for your extra cross-checking purpose. However, from a calculation perspective, can I do this slightly faster? Is it possible for us to do this slightly faster? What am I doing actually? I'm doing 90 into 0.9091, whatever number you get, plus 90 into 0.8264, whatever number you get, plus, and you are doing this again and again and again. And then whatever number you get after adding all of these is coming to 962. Now in school, you have been taught a basic principle that if there is one number which is common, like 90 is common everywhere. If one number is common, you can take it common, like over here. I'm just again doing the basics. Over here, I will say, okay, if I take 90 into 0.9091 plus 90 into 0.8264 common, so everywhere 90 is common. So this is 90 into, for example, 0.9091 plus 0.8264 plus 0.7513 plus 0.6830 plus even the last year. So last year you have 1090. Yes, I understand. Out of that 90 is common, the remaining 1000 is to be done separately. This is what you call as the present value annuity factor. You say that 90 becomes an annuity. Annuity is a number which comes every year at the rate of, let us say, 10% for 5 years. It is like saying that rather than you having to multiply 90 each of the times, I will take 90 common, and then on my calculators, I will directly take the annuity factor. I will never have to write all of this. This is just the first problem. Plus, you will have 1000 into the present value factor at the rate of 10% for the 5th year, the last year, which is, I think, 0.6209. So over here, this is 90 into, if I add all of this, or on my calculator, if I do 1 divided by 1.1 equals to, you get a number, m plus, again equals to m plus, again equals to m plus, equals to m plus, equals to m plus for 5 years. And then memory recall. So this is 3.7908. So you either do 1 divided by 1.1 equals to m plus, equals to m plus. On most of the Casio and Citizen calculators, this should work. Or if you have the Citizen calculator with a gross total GT function, you can directly do 1 divided by 1.1 equals to 5 times, and then press the grand total. You will see the same number. Just check your calculator whether the grand total function is correctly applied over here. And then you have 1000 into 0.6209, which means if you multiply this, this is 90 into 0.37908 m plus, this is 341.17 plus 1000 into 0.6209 m plus 620.9. If I total this, I get this 962.07. So a lot of students over here tend to wonder that, sir, will this work? When will this work? Well, this will work if your cash flows are equal in each year. If your cash flows are not equal, this cannot work. You cannot take 90 common in the brackets, and hence this cannot work if the cash flows are not equal. If they are equal, like in this case, this will work. Secondly, students always think, sir, if I do it in such a short form, will I get marks? If it's a 3-mark question, I need to present a table. Remember, you're not solving a college graduation paper. So you don't think that for you to get more marks, you have to present a table. That is absolutely not the case. You can very well write this in your exam, and the examiner gives you marks for this. So you can be rest assured. In fact, in my opinion, this is even more accurate, because over here, you have taken everything in your memory. The entire discounting factors have gone into your memory, so it's even more accurate. So there's absolutely no problem taking the annuity factors into your calculations. Okay, so this is question number 2. Okay, over here you will have certain notes which we call like reference notes. Remember, reference notes are given for your reference and not to be shown in the exam. So you don't educate the examiner that this should happen and that should happen. No, that is for your education. If there is an exam note written, that is something which you need to write in your exam, but reference notes are not something that you need to write in your exams. Okay, so next we'll go to question number 3. Okay, the reference note is very similar to what we had discussed, where we said that if the coupon rate is greater than the discounted, that is a superior bond and hence it should be at a premium. Coupon rate is less than the discounted, it is an inferior bond and hence it should be at a discount. Whereas coupon rate is equal to discounted, the most important thing, then the market value is equal to the face value, the bond will be at the par value. This is for your reference. Okay, question number 3. Okay, these are basic questions. Whatever is important, I'll tell you separately. A PSU. PSU is like a public sector undertaking, basically a company, is proposing to sell a 8-year bond of 1000 rupees at a 10% coupon rate per annum. Okay, so your term is 8 years, face is 1000 and coupon is 10%. Okay. The bond will be amortized equally over its life. So this is a new adjustment. They tell you that the bond will be amortized equally over its life, which means that the principal value of the bond will be repaid equally over the life. So if the bond is, for example, 1000, that means this sentence implies that 1000 divided by 8, which is 125 per annum. This is a bond where 125 per annum will be repaid in each year. Okay. If an investor has a minimum required rate of return of 8%, what is the bond's present value? If an investor has a minimum required rate of return of 8%, what is the bond's present value? What is written over here? Acha, what is a discount factor? Discount factor is, for example, 8%. So what I want you to do is, for a second, pause over here and ask yourself, will this bond have a final answer of greater than 1000, less than 1000, or can't say? Greater than 1000, less than 1000, or can't say? Develop your thinking process. Thoda zor do. Sir, the coupon rate is actually 10% and the market rate of interest is actually, or the required rate of return is 8%. So this bond is giving me more than what I require. And if a bond is giving me more than what I require, this is like a premium bond for which I should be ready to even pay a premium. It's a superior grade bond. I'm requiring 8, the bond gives me 10, and hence my answer will be greater than the face value, for example. Let us see if that is actually the case. Okay, so if I look at question number 3, let us say we look at question number 3 over here. Again, the value of this bond will be the present value of future cash flows, and here the future cash flows will go on for 8 years. So this is year 1, 2, 3, 4, 5, 6, 7 and 8. Okay. So what are the values? Well, the values over here will comprise of the coupons, but at the same time they will also comprise of the principal payments. Last time the principal payment was made one shot at the end. So if nothing is given, we assume that the bond is a bullet bond where the payment is made at the end. However, here it is specifically and categorically given that the bond will be amortized equally, and hence this is 1000 divided by 8, and hence 125 will be paid each year, and hence your total cash inflow from this bond will not just be the coupon. Like in the first year it is 1000 into the coupon rate at the rate of 10%, and hence this is going to be 100. So your cash inflow will be 225. Acha, will your cash inflow remain the same in the second year? Well, yes, the principal will be repaid still 125, but in the second year when you calculate the interest will now be on 900 into 10%. Sir, why not 900? The interest will be on 875. 875 into 10%. Sir, why 875? Well, because 125 of principal has been repaid, and as a result 87.5 of the coupon plus 125 of the principal, and hence if I total this up, this is 212.5. This is 212.5. Then going further, you will have another, let's say 125 repaid, which means this is 750 into 10%, and hence this is 75. So over here you will keep on doing this. So this is, let us say, 200 rupees. Sir, is there a faster way to figure out the interest? Again, yes. Remember, your principal repaid is 125 and the coupon rate is 10%, which means if the principal is falling by 125, then the interest saved will be 125 into 10%, that is 12.5. So if the first year's interest was 100, the second year's interest will be 87.5, that is 12.5 lower. The third year's interest will be 75, that is another 12.5 lower. If I take this further, this analogy, 62.5, 50, 37.5, 25, 12.5, and then ultimately the entire bond is repaid. In each of the years you will have 125. Sir, we are preparing this big table. You just taught us that we can use the annuity factors. We will use the annuity factors over here. You tell me, Can we use the annuity factors over here? Well, the answer is no, because in this particular case, your cash flows are not uniform in each year. Cash flows is the total cash flows comprising of principal and interest, and as you can see over here, the cash flows are not uniform. And if they are not uniform, then well, you cannot use the annuity factor. So this is 150, this is 137.5, and we take the discounting factor. The discounting factor is at the rate of 8% in this case. Again, you will, we can find the present value. Once you are comfortable, you can directly refer to the solution over here. So if you take 8% over here, 1 divided by 1.08, 0.9259, 0.8573, 0.7938, 0.7350, 0.6806, 0.6302, 0.5835, 0.5403, and hence if I multiply these, this will be, let us say, 225 into 0.9259 m plus 208.33. Again, you don't need to write this, I'm just writing it for the purpose of reference. So this is, let us say, 225 into 0.9259. Then you will have 212.5 into 0.8573, again m plus, let's say this is 182.18, and so on. So this is 200 into 0.7938, 187.5 into 0.7350, 175 into 0.6806, 162.5 into 0.6302, 150 into 0.5835, 137.5 into 0.5403, and the total over here comes to approximately 1070.41, 1070.41. Acha, does something strike a chord over here? Well, we expected the value to be greater than 1000. Well, it is greater than 1000. If it was not, maybe you missed one of the numbers and the answer comes to, let's say, 900 and something, you would say, yeah, how is it possible? And you will check. Otherwise, it's impossible to sit and calculate each and every number again. So you will have to develop some cross checks in your mind to kind of at least get a sense on which your answer is going in the right direction or not. It may not necessarily be right, but at least you will get a sense on whether it is in the right direction or not. So the value over here will be approximately 1070.41. If you look at question number 3, after doing all of these, you get approximately 1070 point something, and your principal repaid, let us say, we have just shown the working. So this is question number 3, a fairly basic question. Next, you will go to question number 4. This is slightly interesting over here. In this question, there will be 2 rates which is given. You will have to select the discount rate. Remember, while selecting the discount rate, you have to ask yourself that what is the objective of doing that? What is the objective of selecting the discount rate? Well, the objective over here is to find the present value. But for whom are you finding the present value? Are you finding it from the perspective of the investor? Then the investor's required rate of return will be the discount factor. Are you finding it from the perspective of the company who is planning to issue a bond? Then the rate of return that the company wants to give to the investor will be the discounting factor. So for example, the market rate of interest is, let us say, 10%. However, the company is coming up with an IPO, initial public offer, where it wants to give a bond which is very lucrative, and as a result it wants to price the bond in such a way that it gives a higher return to the investor than what is there in the market. I want to actually give a higher return, let us say like 11%, in which case what should be the appropriate discount factor to be used? Well, if I am doing evaluation from the investor's perspective, I will not care what the company wants to give me. I will say that what is the value I will pay in order to safeguard minimum my required rate of return. So investor will take 10%, that is the rate of return he requires. However, if I am doing it from the company's perspective, who is deciding to price the issue, the company might decide on a rate of return that it wants to give to the investor, let us say 11%, in which case if the question asks you to calculate the issue price, that is the price at which the company should issue the instrument, that will be based on the rate that the company wants to give to the investor. In general, the company wants to give to the investor the rate that the investor expects. However, sometimes if you track financial markets, you must have seen there are certain IPOs which get heavily oversubscribed. Partly it is because the company, in investors' language, leaves something on the table for the investor. They know that the market rate is 10%, but they're leaving something on the table for the investor, and hence these bonds become very popular because the investors are getting more than what is given in the market. So based on that, you will read question number 4. It's a fairly interesting bond. This company is contemplating a debenture issue on the following terms. The face value is 100 rupees per debenture. Okay. Term to maturity is 7 years. Coupon rate of interest from years 1 to 2 is 8%. 3 to 4 is 12%. 5 to 7 is 15%. Now this is a staggered interest bond. Sir, are these bonds there? Yes, a lot of times infrastructure companies issue these bonds because they might need a lot of money to construct a project. So at the early days of construction, the company does not have cash to pay, and hence there will be negligible or 0% interest. And then once the project is completed, and let us say a toll project starts generating toll revenue, then there is very negligible cost that the company has to incur, but there is huge revenues that they get, and hence they are ready to pay even higher rate later. So these are staggered interest bonds. The current market rate of interest on similar debentures is 15%. So the investors will expect 15% on your bond as well. The company proposes to price the issue so as to yield a compounded return of 16% to the investor. The market rate of interest on similar debentures is 15%. However, the company proposes to price the issue in such a way that the return is 16%. Okay. Determine the issue price. What is asked in the question? The question says determine the issue price. Assume redemption happens at a premium of 5% on the face value. Now this is where you might potentially make a mistake. If you want to think at this stage, pause the video, think on your own. This is how thinking process develops. Okay, pause the video, think on your own, figure out whether the coupon rate, how do you give effect to these different coupons, what is the redemption value, what should be the discount rate, consider everything and then resume. Let us say we are going to question number 4. Now the value of this debenture also is a present value of future cash flow. So if I want to find the value, sir, what is the value? Value is, in this case, you want to find the issue price. So if you want to find the issue price over here is also the present value of future cash flow. So you will find year 1, 2, 3, 4, 5, 6 and 7. There are 7 years. And what is the cash inflow? Unlike the last question, we have not been given over here that this is an amortizing bond, which means the interest will be paid each year and the principal will be repaid at the end. However, interest over here is paid at different rates. In the first year, it is paid at, I think, 12%. Sorry, 8%, then 12%, then 15%. So we will record it. And then the discount factor, what should you take? Sir, in such questions, it is very difficult to figure out whether the answer will be greater than 100 or less than 100. Why? Because in this particular question, there is different interest rates. There is also premium on redemption, and hence in such a case, it becomes slightly difficult. Though in this case, you might still find it because whatever the rates are, they are equal to or even less than the discount factors. But nevertheless, in such questions, it is slightly difficult. So we will say that, okay, in the first year, 8, second year 8, third year 12, fourth year 12, and in the last 3 years, this will be 15. In the last year, students typically tend to make a mistake. They say, okay, we will get 15 plus, we say 100. See, 100 is the face value. Usually you get the face value back, but in this question, the last line of the question tells you that the redemption happens at a premium of 5%. And hence, one can reasonably say that what we will get back is actually 105. Sir, how 105? Well, 100 for the principal plus 5% premium that is agreed on redemption. Assume a redemption premium of 5% on the face value, which means you are going to get 105 back along with 15, and hence this will be 120. Okay, so this is the first challenge. Second is the discount factor. Discount factor should be at what rate? Sir, we have been asked to determine the issue price. Issue price is determined from the perspective of the issuer, and hence the discounting factor should be the rate which the issuer intends to give. the issuer intends to give a return of 16% and that should be the discounting factor. Sir, but the investor expects 15. Let the investor expect 15, 14, 12 or even 17. If the company wants to price the issue in such a way that the investor gets a 16% return, then the issue price will be 16% के base पे. Sir, but the investor will use 15% rate, investor will look at 15. Yes, investor will probably look at 15. And as a result, the intrinsic value of this bond will be higher than the issue price, and hence you see a lot of times in IPOs at the time of opening there's a huge increase in price. That is because, among other factors, one can always say that, well, the issue was priced at a discount, or issue was priced so as to give the investor a better return. Okay, so in this case the discounting factor, remember, will be 16%. Over here as well we would have written a note that why 16. Just to kind of come to that reference note, as a question requires to calculate the issue price, we should take the return which the company wants to give to the investors, that is 16%. Achha, had the question asked you to calculate the value of the bond from the investor's perspective, if the value of bond from investor's perspective was asked, then we would have taken 15%. But here it is from the company's perspective, and hence this is 16. 1 divided by 1.16, let us say this is 0.8621, 0.7432, 0.6406, 0.5523, 0.4761, 0.4104, and lastly 0.3538. So if I multiply all of these, you will get the final answer, which is the present value, which is the value at which you will issue so that the investors get a 16% return. This is 8 into 0.8621. Again, you can't use the annuity factor over here because the numbers differ in almost each year. 12 into 0.6406, 12 into 0.5523, 15 into 0.4761, 15 into 0.4104, and 120 into 0.3538 M plus MRC, around 82.91. Sir, what is 82.91? Is it the intrinsic value of the bond? Well, in this case it is the issue price. Usually the issue price is also equal to the intrinsic value. However, in this case, if someone wants to find the real value, intrinsic value, from an investor's perspective, an investor would say that, okay, company is giving me 16, but I'm happy even at 15. So what should be the maximum value I should be prepared to pay on this bond? Like, for example, I make an application in the IPO, I'm not allotted. Then on the day when the stock gets listed or the bond gets listed, I want to buy from the market. So I want to figure out how much should I pay. For that purpose, I will have to consider 15%. So if an investor has to determine, they will take 15%. However, here this is 82 point something, 82.91. Over here this is 93. Remember, there will be certain rounding off depending on the number of decimals taken as well. So this is 82.93, and this will give you the value of the bond. Perfect. So this is question number 4. Next you go to question number 5. This I can consider that you rate it as important. Even question number 4 you can treat it as important to some extent, because here you have to select the discount rate consciously. Achha, question 5 is a bond where there is a bit of work to be done. Like, for example, in this particular bond you have to find the interest, coupons, etc. What if it is semi-annually? All the questions that we have done till now assume that interest is paid annually, which is normally the case. But if you look at US bonds, etc., most of them give you interest half yearly. So over here, let us say it is a bond which is a 3-year bond with a face value of, let us say, 1000, coupon rate, for example, unless given otherwise, of, let us say, 10% per annum, and the market rate of interest or the discount factor, let us say, at the rate of 12% per annum. Market rate of interest, also called as the required rate of return, is 12% per annum. So usually what do? We say years 1, 2, 3, cash inflow, let us say in the first year will be 1000 into 10%, which is 100, then again 100, then 1100. Achha, is that correct? Am I actually going to get 100 at the end of the first year? No, sir. I'm going to get 100, let's say 1000 into 10% into 6 by 12, that is I'm going to get 50 rupees after 6 months, that is half a year. I'm going to get another 60 rupees after another 6 months. So 50 rupees I'm going to get. So this 100 is not received entirely at the end of the first year. Out of this 100, 50 rupees is received at the end of the first 6 months. Another 50 is received after another 6 months. And as a result, when we do this working, so let us say this is years. Basically, in this case, you will say half years. At the first half year end, you will receive 50. At the second half year end, another 50, third half year end, another 50, fourth half year end, another 50, fifth half year end, another 50, and then at the sixth half year end, you will get your principal, that is 1000 back along with 50, and hence you will get 1050. Ajay sir, what have you done? We have divided the coupon rate by 2. We are saying that, well, 10% per annum is 5% for a 6-month period. Again, the term we have multiplied by 2. Basically, 3 years is equivalent to 6 half years, and the actual coupon in each of the half year is, for example, 5%. Acha, when we are looking at the discounting factor is usually 12%. So you will take 12% over here. No sir, the discounting factor is 12% per annum. I am taking this for each half year. So 12% per annum is 12% divided by 2, that is 6% for the half year. So the discounting factor over here will be 6%, and hence you can do the working. So this is 1 divided by 1.06. Let's say this is 0.9434. Karte you will find it for each the numbers, and you will find the present value. Sir, in this case, is the interest in each of the years constant? Yes, and hence you can use the present value annuity factor, where you can say, okay, 50 into the present value annuity factor at the rate of 5% for 6 time periods plus 1000 into the present value factor. 1000 is not coming in each of the years, it is coming directly in the 5th year only, at the rate of 5% for the 6th time period. So when I do this working, this will be 1 divided by 1.05, 1, 2, 3, 4, 5, 6. Over here, this will be 0.7462 and 5.0757, and hence let us say this will come to equals 50 into 5.0757 m plus 1000 into 0.7462 m plus MRC, and hence this is coming to approximately, just a second, oh, I've taken wrongly 5% over here. So over here, if you see the answer was coming to 1000. If you look at my answer now, your answer will come to 1000. You will say, how is it possible? Coupon rate is not equal to the discounted answer, cannot be 1000. So this is where it kind of helps. So over here, sir, हमको पहले ही strike हो गया था. We had seen that you had taken wrong. Shabash, very nice. So over here, this is, let's say, at 6%. So if I go to see over here, conceptually your answer has to be less than 1000. Sir, why? Because your coupon rate is 5, required rate is 6, and as a result, you are getting less than what you require, and hence this is an inferior bond, will go at a discount. So this is 1 divided by 1.06, 1, 2, 3, 4, 5, 6. So this is, let us say, 0.7050 approximately, and then grand total, this is 4.9173, and hence we take 50 into 4.9173 m plus, this is 245.87 plus 1000 into 0.705 m plus, this is 705, and hence your total comes to 950.87. So this is 950.87. This will be your total. Are we clear with this? Okay, so as expected, the value is lower. Sir, but this is half yearly. What if this is quarterly? Well, the functions will remain the same. When you look at, there are 3 essential features in a bond, right? So there is the coupon, there is the discount factor, and then there is the term or the tenure. So whatever is a coupon, let's say whatever percentage per annum, discount factor whatever percentage per annum, and the term is in years. So when you look at half yearly, the frequency of these cash flows will be 2 times in a year. If you look at quarterly, the frequency of these cash flows will be 4 times in a year. If you look at monthly, the frequency of these cash flows will be 12 times in a year. In which case, I would say that the coupon over here will be divided by something called as M. M is the number of times in a year the cash flows are going to happen. In case of semi-annually, this will come 2 times. In case of quarterly, this will come 4 times. If the coupon is, let us say, for 3 months, in case of quarterly payments, the required rate of return should also be for 3 months, and hence you will divide also this by, let us say, 4. So you will say that, okay, 12% per annum equals 12 divided by 4, that is 3% for 3 months. That is a required rate of return. And if you look at number of years, that is a time period. We would say that 3 years, okay, but you are not getting cash flows only over 3 time periods. You are getting it 4 times in a year. And there are 3 such years, and hence 4 into 3, that is 12 quarters. You will get cash flows over 12 quarters, and hence over here you will multiply this by M. If you do that, this is what is going to give you the cash flows or the valuation in case of a bond which is not annual. So if you need to do valuation of a bond which is not annual, like it is there in question number 5, then what will you do? If I go to the shield on page number 5, there are a few key points over here. The first key point is that, the second key point is that coupon rate and discount rate are given on a per annum basis. In case cash flows are not annual, then the following changes will be made. Coupon rate divided by M, discount rate divided by M, and the time period multiplied by M. Sir, what is M? M is the frequency in a year when the cash flows are received. That is semi-annual 2 times, quarterly 4 times, monthly 12 times. Based on this, you will refer question number 5. Question number 5 is based on this. ऊपर जो point 1 अपन ने लिखा था, this is question number 4, the selection of discount rate. In case the question requires us to calculate the issue price, we should take the return which the company wants to give to the investor. However, if value of a bond from investor's perspective was asked, we should take the current market price of similar instruments, that is opportunity cost. So this is in the shield, we have compiled everything at one place. So there are so many different questions which have different adjustments. Now we have compiled everything in one small section where all of these adjustments can be traced back very easily. Like over here, we have even shown the key relationships, like we saw this in question number 2, the key relationships, exactly the same thing. Okay, perfect. Let us go further. There is one more key relationship which is remaining, which we will do at the appropriate time. Right now, let us get some understanding. Question number 5. A 6-year bond with 1000 rupees has an annual rate of interest of 14% per annum. Achha, this is an annual rate of interest. Okay. The term of the bond is 6 years. The face value seems to be 1000 and the annual rate of interest. So this is like a coupon. Seems to be 14% per annum. The interest is paid half yearly. Okay, this is the adjustment which it makes it a little tricky. The interest is paid half yearly. If the required rate of return on the bond is 16%, again, unless given otherwise, this is always per annum. The required rate of return is always a percentage per annum unless otherwise given. What is the value of the bond? So this is like the discounting factor. So if you look at question number 5, over here, the adjustments that you will have to do is the coupon over here is given to you as 14%. This is clearly an annual coupon. So this is 14% per annum. That is 14% divided by 2. It is semi-annual bond and hence half yearly frequency. So this is 7% for a 6-month period. The discount factor over here is, I guess, 16% per annum. 16% per annum, that is 16% divided by 2, which will come to 8% for a 6-month period. At this stage, आपके दिमाग में बत्ती जलना चाहिए. Sir, coupon rate is 7%, required rate is 8%, or coupon rate is 14%, required rate is 16%, which means you are getting less than what is required. This is an inferior bond. Your answer has to be less than the face value. Your answer has to come to be less than 1000. If it is more than 1000, probably it requires some level of checking on whether you have done it correctly or not. Achha, is that it? Sir, the tenure, the term over here is 6 years. However, 6 years is equivalent to 6 into 2, which is equal to 12 half years. This is equal to 12 half years. And hence, the working will be done based on these numbers. Sir, do I need to prepare the table? If you want, you can prepare. There's no harm in doing that. However, if you want to save time in your exams, rather than preparing a table separately, what you will have to do is you will have to find the present value directly. So over here using an annuity factor, so the value of this bond today, is the present value of future cash flows. Sir, what are the future cash flows? Well, the bond is 1000 into, let us say 14% into 6 by 12, or let us say 7%. I'm going to get 70 rupees. When am I going to get 70 rupees? After 6 months, that is after 1/2 year. Then I'm going to get another 70 rupees. When am I going to get another 70 rupees? After another half year. And so on. There are going to be 12 such half years. So into the present value, let us say annuity factor at the rate of, sir, what rate am I going to take? 8% for 12 time periods. Okay. Plus I'm going to get 1000 into the present value factor at the rate of 8%, this time for the 12th time period. And hence 1 divided by 1.08, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I think I get 0.3971, and on the totaling this is 7.53. 61. Sir, how did you get that? Well, 1 divided by 1.08 equals to, we do that 12 times. Whatever number you get at the end, we get that as the present value factor, and then you press the grand total function if you have, otherwise equals to m plus, and then MRC, you will get the annuity factor. So this is, let us say 70 into 7.5361 m plus, this is approximately 527.53 plus 1000 into 0.3971 m plus, so this is approximately 397.1, and if I total this, it comes to 924.63. 924.63. This is less than 1000 as you expected, and as a result this will be treated as the value of the bond. So the value of the bond today is, let us say, 924.63. Okay, so that kind of takes care of this question. If we verify, this is 924. So we have just mentioned that as cash flows in each time period are constant, we can use the annuity factor in this question as well. Perfect. So that is question number 5. Acha. Now before you proceed further, we also need to understand something about the measures of return. So the measures of return for a bond, how do you find a return for a bond? These are also called as yield. Yield is another word for the measure of return. So there are 3 different measures of return. First, there is something called as current yield. Now this is something which is very, very basic. So if I take question number 2 as a reference point over here, then in question number 2, if you remember, what were you getting? Let us say question number 2, your price was coming to be 962.06, coupons were at the rate of 9%. So let us say over here, if I look at question 2 as a base, in question number 2, your coupon was, I think, 9%. Your price of the bond came to approximately 962 point something, and your term, I think, was around 5 years. This is what was there in question number 2. So what is the current yield? Current yield says that you will calculate the interest, that is the coupon receipts of this bond, and divided by what? Sir, we will divide it by face value. Incorrect. We are not investing the face value. Yield is like the return. Return is on investment. How much are you investing? Sir, we are investing, let us say, the price, intrinsic value, market price, whatever it is. Generally, if a market price is given, you take the market price. If not given, you will take the intrinsic value, which is similar, assumed to be similar to the market price. So over here, we will say that, okay, we are going to get 90 rupees as coupon in each of the years in question number 2 on approximately a 962 investment, which means 90 rupees on the base of 962 investment will come to approximately 9.36%. So let us say this is approximately 9.35 or 36%. This is what you call as the current yield, the easiest measure of yield. Without any surprises, is this a very commonly used measure of yield? No. Sir, why? Because it ignores A, the time value, B, it completely ignores the capital appreciation. We are considering the fact that, okay, the return is only made up of coupon, which is wrong. If this was a 0 coupon bond, the current yield would be 0. Let us say this was a 0 coupon bond, then 0 divided by whatever is the price, well, you are going to get 0%. That is wrong. And hence this is not a very popular measure of yield. It is a very generic measure of yield. So we want to consider the capital appreciation. We also want to consider let us say your time value. So you go to a slightly more advanced measure of yield, which is called as the realized yield. Now realized yield we will do in some time. I mean, we'll understand the concept over here, but over here you will need some more calculations. So we'll first figure on the concept. What is the concept telling you? The concept tells you that your investment today is how much? Sir, investment today is approximately 962. In return, what are you getting? Sir, you are getting here 1, 2, 3, 4 and 5. You are getting cash inflows of 90, 90, 90, 90 and 1090. Perfect. So if I total up, this is 1450. Acha. So what does realized yield say? Realized yield says that if I look at the compound interest formula, A is equal to P into 1 plus R raised to N, that is the future value equals to the present value into 1 plus R raised to N. So what I can loosely say is, in the future, in total, I'll have 1450. Sir, 1450 can't say, it is a total of all the cash flows. Achha, including the redemption value, all the cash flows, which will equal the amount that you are investing today, which is approximately 962 into 1 plus R. R is your realized yield raised to 5. Achha, if I do this working, that is 1450 divided by 962. So over here, in a way, your capital appreciation might also get covered because you're considering 962 and at the end you are also considering 1000. But it is not in the most efficient way. So this is into 1 plus R raised to 5. So this is 1450 divided by 962. That is 962 today becomes 1450. So this is approximately 1.5073 equals 1 plus R raised to 5. Now the problem is, if you want to find 1 plus R, you have to take the fifth root, that is 1.5073 raised to 1 by 5 equals 1 plus R. Achha, now the problem over here is the fifth root cannot be calculated directly. You will have to use the help of logarithms, and hence I don't want to bog you down for the time being with logarithms. We will do that. You might have to apply. We will do even the logarithms that you can do directly on your calculators as well. So we will take the shortcut, the traditional logarithm table value, as well as a shortcut which can be done through the calculators. However, you will have to use the logarithm values. Sir, always? Well, it depends. So for example, if this was, the term was 4 years, then the fourth root can be taken on your calculator if you are aware. The fifth root cannot be. So in certain cases, you will have to use the logarithmic value in order to find the answer. So over here, for example, if this was for a period of 4 years, then you could have taken the fourth root and found the answer. Achha. Is realized yield popular? What do you guys think? Again, no, because again it is not incorporating the effect of time value properly. For the realized yield in this method, 90 rupees whether received in the first year or 90 rupees received in the fourth, there will be one and the same. We are assuming that there will be no reinvestment. You will receive 90, you will keep the 90 as it is, and then after 5 years, this will become 1450. That is fundamentally not how it happens. This 90 might also be potentially reinvested and a return can be earned. And hence realized yield, though we will study it, is not considered to be very important. Then sir, what is important? Well, the next measure of yield is yield to maturity. This is something which is extremely important. What do you mean by the words yield to maturity? Yield means the return to maturity, which means if you were to buy the bond today, at today's price, so your purchase price gets fixed, it is a price today. And second, if you were to hold the bond till maturity, Sir, why till maturity? Well, if it is a 5-year bond and if you decide to sell it after 2 years or 3 years, we don't know at what price you will sell it after 2 or 3 years. However, if you hold it till maturity, there is absolute certainty that at the end of the 5th year, you are going to get 1000 rupees. And hence, this is a return that I will get if I were to hold the bond till maturity and purchase it at today's price. So there are two ways in which you can find the yield to maturity. One is the approximate way, and one is, sir, this is the approximate method, which is, I mean, if you don't have time in the exam, you can do that. However, there is another more accurate method, which unfortunately is calculated using the trial and error. Sir, why trial and error? Remember, yield to maturity is nothing but the IRR of the bond. Remember IRR, internal rate of return? IRR you must have done in your inter CA as well, in your capital budgeting chapter. What did IRR tell you? IRR tells you that the present value of cash outflow should equal to the present value of cash inflow. Treat the bond as a capital budgeting project. If this was a capital budgeting project, let us say question 2. In question 2, it was a slightly rephrased question. You were given that the market price of the bond is 962. Let us say 06. You were given, for example, that the coupon rate is, for example, I think in that question 9%. You were given that the face value equals to the redemption value equals to 10,000, and you were given that the term is 5 years. So what is missing in this question? Well, the investor's required rate of return or the market rate of return. But if you assume the market is efficient, in which case if investors are willing to buy the bond today at 962.06, then the return that this bond gives you is the return that the investors are happy getting. So over here you will say the approximate yield to maturity, you will say approximate yield to maturity can be calculated as the interest. Sir, but interest over here is not complete. Yes, plus the redemption value minus the market price. So this will help you in the capital appreciation. Acha, but the problem is, sir, interest is on a per annum basis, 90 is per annum. However, the capital appreciation, that is 1000 minus 962, for example, I mean 0.06 for the time being chhod dete, 962. This is capital appreciation that you will get only once. However, you want to find a return per annum, so you will say, okay, 1000 minus 962 comes to 38. 38 is, let us say, going to be received once over 5 years. That means if I want to convert it into a per annum number, 90 to every year, in each of the 5 years I am going to get 90. However, the appreciation of 38 you are going to get only at the end of the 5th year. So if I want to convert it into a percentage per annum number, how will that happen? Well, I will say 90 plus, let us say 38 divided by 5, which is approximately 77.6 per annum. As you can see over here, it's an approximate number. Upon, in the denominator, well, you can consider the opening balance as well, but at a lot of places people do end up taking the average investment over here. So this is 962 at the beginning plus, let us say, redemption value, it is 1000 at the end, divided by 2. If you remember in your inter C also, if you remember return on capital employed, you used to take in the denominator average capital employed, average ROE. So over here also, let us say they are taking average, because in the numerator you have a return which is for the period, in the denominator you have investment as on date, so probably they are taking average. So which is 962 and 1000, 1962 divided by 2, which is 981. So over here this will give you, let's say, 97.6 divided by 981 into 100. So this is approximately 9.95%. In case of bonds, there is not too much of an uncertainty, and hence this approximate YTM also works. However, this is again a little crude in the sense that it does not properly take into consideration the time value of money. And again, it is approximately finding the capital appreciation per annum. So what happens over here, listen to this very carefully, is in practice, and if you open financial news like CNBC etc., you will almost always see the yield on the bonds. The market price of the bond is not as frequently quoted anywhere. It is very normal for you to see what is the prevailing yield on the bond, what is the return that an investor will get if he were to invest in the bond at today's price and hold it till maturity. It is a very popular way in which bonds are actually quoted. There is a market price of the bond, but it is more commonly, if you see financial newspapers, CNBC etc., you will see the yield being quoted, and that yield is the yield to maturity calculated using the trial and method, exactly the way we are going to do now. So over here we will say that, well, what do you mean by IRR? If you remember, IRR refers to the rate when the present value of cash inflow equals to the present value of cash outflow. I will again repeat, IRR is the rate at which the present value of cash inflow is equal to the present value of cash outflow. So IRR is the rate at which PVCO equals PVCI. So if I am an investor, what will be my PVCO? What will be my present value of cash outflow? Sir, the initial investment. Initial investment, I think 962 or so, 962 point something will be your cash outflow. Apart from that, the investor does not have to invest anything else. Acha, when I look at PVCI, what is going to be my present value of cash inflow? Sir, my present value of cash inflow will comprise of, let us say, years 1, 2, 3, 4 and 5. As an investor, what am I going to get? Well, I am going to get 90 rupees in year 1, 2, 3, 4 and 5. Let us say this was not a bond. Let us say this was a capital budgeting project where you were investing 962 in a machinery, in a project, and this machinery was going to give us 90 rupees in each year, and then 1090 including the salvage value at the end of the 5th year. If you want to find a real rate of return that the machinery gives you, how will you find that real rate of return? Well, we will find it by calculating what you call as an IRR. IRR is going to help you to find the real rate of return that you get on the machinery. That is a capital budgeting project. Well, here treat the bond as a capital budgeting project. In this case, if you were to invest, for example, 962 into a bond, this 962 that you are investing in a bond is going to give you 90 rupees in each of the year, and then it is going to give you 1000 rupees at the end of the 5th year. And as a result, over here you will say 90 into the present value annuity factor, but you don't have that, and that is why you use a method called as trial and error method. Acha, we will study this in a little bit of detail, but trial and error refers to you starting with a random number. Okay, approximate method gives you a 9.95%. So let us say you start approximately at 10%. How did we get 10%? We will develop this art, but for the timing we know the answer. So let us say we have started, let us say at 10%. In which case we will say PVCI is 90 into the present value annuity factor at the rate of 10% for a period of, let us say, 5 years, plus 1000 into the present value factor at the rate of 10% for, let us say, the 5th year. In which case over here this is 1 divided by 1.1, 1, 2, 3, 4, 5. This is 0.6209 and this is 3.790. By the end of this course कुछ आपको आए या नहीं आए, आपको 10% के present value factors वो आपको आ ही जाएंगे. So over there this is 90 into 3.7908 m plus, this is probably 341 point something, 0.17, and this is 1000 into 0.6209, this is 620.9. So if I were to round this off in a way, this is approximately 341.17, you add 962.07, or probably let us say 962. Over here these two numbers equal. Do you think in your exam, in your interest year, they ever equal? No, they will never equal. Here we knew the answer, so we were doing it, because in question number 2, if you see, the discount factor was 10%. However, will they equal? No. Sir, what will happen if they don't equal? Well, you will have to take the help of a special process called as interpolation. We will study how interpolation happens, but here we don't need interpolation because 10% is a rate where the PVCO equals PVCI, and therefore the IRR, internal rate of return, also called as the yield to maturity, YTM, comes to be 10%. What does this number indicate? When will you calculate YTM? Well, if the price of the bond is given. In question 2, price was not given, the discount factor was given. When you study, I think question number 7 or so, just a second, let me see. I'll just discuss, but when you see other questions, I think thoda aage hai, question 9 or so. Yes, if you see question number 12, where is this, 13 hoga. Yes, if you see question number 13, for example, you have a 5-year bond with a 8% coupon. So term is given, coupon is given, and a maturity value of 1000, redemption value is given, and is currently selling at 925. So over here market price is given. What is its yield to maturity? So the question is asking yield to maturity, in which case the discount factor is not given, and the discount factor can be calculated using the trial and error method. Over here you will start at a random starting point. For example, over here you started at 10%, and coincidentally your present value of cash outflow becomes equal to the present value of cash inflow, and hence that 10% is the IRR. That is the yield to maturity. That is the return that you will get if you were to invest in the bond today and hold it till maturity. You will get a 10% return. That is the yield to maturity. However, if the rate is not the same, in which case you will have to do a process called as interpolation, which we will do. Probably we'll stop for a breather at this stage, but on the other side of the break we will do interpolation and apply that as a part of various sums. But in this case we want to first fundamentally understand what is YTM. Then we will see that, okay, if the rates are not equal, like you did in your inter-CA, you might have, if you remember, you did a process called as interpolation and found that rate. But what does that rate signify? It signifies a real return, considering time value, considering capital appreciation, considering the dates and the times when coupons and principals are paid. That is a return that a bond generates, and that is a very important number. Generally, if you want to find the market rate of interest for a bond, you will take a proxy bond, for example, a government bond. You want to find a market rate of interest for a 10-year investment. You will take a government bond and you will say that how much is the market price of the government bond, what are its cash flows, so what are investors ready to pay in today's terms. That is the market rate of interest. This is how people actually imply market rate of interest. Or in practice, you might have a basket, or let us say 10 or 15 bonds of a particular maturity, and you will find the returns on each of their bonds and the average rate. Like if you go to banks have fixed deposits, so you will take the fixed deposit rate of SBI, HDFC, ICAI, similar, and you will say the average fixed deposit rate for a period of 5 years is so and so. But in bonds, you see the market price. Fixed deposit does not have a market price, bonds does have a market price, and hence the market rate of interest can be derived by finding yield to maturities for each of these bonds, similar category bonds. That will give you a sense on the market rate of interest just from a commercial standpoint. Okay, so over here I'll just read some basic theory and then we can stop for a break. This key point is still to be discussed. Measures of yield. Measures of yield, that is return, the average measures, comprises of current yield. Current yield is the annual interest, that was 90 in our question, upon 962. This is an approximate measure since it does not consider the capital gains or time value, and hence it is not commonly used. Okay? Second is the realized yield. This represents a return by comparing the total cash flows generated over the entire life. So in question number 2, we said 1450 was the total cash flows with the current market price using compound interest formula. 962 was your current market price for question 2, and hence you find this. Log tables may need to be used to find the nth root if it cannot be solved directly. Alternatively, we can use shortcuts to calculate log values on the calculator as well, which is discussed in derivatives, which we can refer, but currently we first want to understand concepts and then the calculations. The measure of yield does not consider time value accurately, like cash flows received in year 1 have the same weight as those received in year 5, and hence it is again not very commonly used. So what is commonly used? Sir, yield to maturity. It is a rate of return that an investor would earn if he buys a bond at current market price and holds it till maturity. So if you buy it, your cash outflow is fixed and then your cash inflows are also fixed, and hence your return gets locked, frozen. It represents the IRR of the bond. IRR is generally calculated by the trial and error method. This being a lengthy calculation can be approximated by using the following formula. Like you take interest plus the average capital appreciation upon the average investment. Like we discussed, in the exam it is advisable to use the trial and error method while calculating the YTM, that is yield to maturity. The above working will help to find a starting point for the trial and error and can be done in rough as well if you want. So there are a lot of questions based on this. We will study interpolation in detail as well, but in the meantime we will take a short 5-minute breather, and on the other side continue with the second half of the lecture. See you in 5 minutes. Okay, so let us resume back. We'll go to the questions over here. We'll first go to the relatively simple questions, then a step further where the rates would be given for interpolation, and then where you will be in the open where you will have to probably find a rate for interpolation. Okay, so let us go to question number 6 now on page number 4. So let us read question number 6. What are we supposed to do? Sir, we are supposed to calculate the market price of sub point 1, a 10% government of India security currently quoted at 110. Quoted would mean the current market price is 110, but the yield is expected to go up by 1%. Yield can mean current yield. In the order, the yield should ideally mean the yield to maturity, or if not available, then it should mean the realized yield, or if not available, it should mean the current yield as the last preference. Over here, let us say if you assume this to be yield to maturity, let us say you can, and you assume it to be yield to maturity, the yield to maturity would need, among other things, if you want to find the price is the present value of future cash flows. Now, you need to know for how many years this government of India security is there. In this particular question, it kind of remains silent. It does not tell you the number of years. Well, it can be 10 years, 15 years, 20 years, 30 years. Well, we don't know. So the current market price is 100. We don't even know the face value. Well, we can assume the face value, let us say, to be 100. We don't even know the redemption value. So there are a lot of missing pieces over here. So what can we do? Well, ICAI over here has said that YTM will not be feasible in this particular case because we don't know the yield to maturity. You need to know the maturity, right? Even for realized yield, you need to know for the how many number of years this continues. So in this case, neither YTM is feasible nor is the realized yield feasible because in sub point 1, the maturity is not available. So which data or which measure of yield does not really require maturity? Yield to maturity requires the number of years to maturity. Realized yield assumes that all the cash flows at the end of maturity will be worth how much as compared to the market price. It also needs a maturity. However, when you look at current yield, sir, what is the formula for current yield? I'll write it in short. Current yield or CY equals the interest and you will divide it by the market price. In this case, do I have the, let's say, into 100? If I do into 100, for example, it becomes a percentage. If I don't do into 100, you can show it as a decimal value. So the question over here says a 10% Government of India security currently quotes 110. Okay, so I know that the current market price is 110, but the yield is expected to go up by 1%. But what is the yield currently? We don't even know that. So over here, let us say the interest, we say, let us assume the face value is 100. So 100 into 10%, let us say, is the interest into 100. So this is 10 upon 110 into 100. So your current yield comes to 10 upon 110 into 100, which comes to, let us say, 9.09%. This is, let us say, your current yield. This is, let us say, your current yield. Acha. Now your expected yield. Your expected yield would be 9.09% plus 1%. The question tells you that the yield is expected to increase by 1%. And hence this becomes 10.09%. Okay. Now the value of a bond is ideally the present value of future cash flows. So that is probably 10 rupees of coupon in year 1, year 2, year 3. But for how many years we don't know. So again, we can say that, well, if there is a revised current yield which is equal to interest, the government will still keep on paying the same interest. However, what that will ultimately result is in the revised market price. So if I want to take the revised yield, which is, for example, 10.09, it equals the interest, which is 10 upon, well, the revised market price into 100. And as a result, we will say that the revised market price equals 10 upon 10.09 into 100. So over here, this is 10 divided by 10. This is 10 divided by 10.09 into 100, and this is 99.11. So this is, let us say, 99.11. Remember, this is not the best way to calculate your price. However, with the resources that you have, if not the best, we need to look at the next best. So over here, if you look at your reference in part 1, in this case, a term that is maturity of the bond is not available, and hence it is not possible to calculate the YTM or realized yield. However, the current yield can still be calculated even in absence of the maturity, and hence we have solved this question based on the current yield. So this is the reason we need to tell the examiner why we have taken the current yield in this particular case. Okay, is the question over? Not yet. Sub point 2, a bond with 7.5% coupon interest, face value of 10,000 and term to maturity of 2 years is presently yielding 6%. In this case, you have been given 2 years, and hence the yield, unless otherwise given, can be assumed to be the yield to maturity. If nothing, it is like saying, if you remember in your inter CA, you had a cost of capital concept. In cost of capital, you had various measures like CAPM for KE or Gordon's growth for KE or earnings yield or dividend yield. We said that ideally KE will be calculated, let us say, by CAPM or by Gordon's formula. Dividend yield, etc. were kept at the end. We'll study that further as well, but I'm just giving you perspective. So if data is available, we'll always assume that the yield is the yield to maturity, and hence even when we found the value of bonds, we took the present value of future cash flows. So 7.5% bond, face value is 10,000, term to maturity is 2 years, and the bond is presently yielding 6% unless given otherwise. This is the yield if I buy the bond today and hold it till maturity, that is for 2 years. Now interest is payable half yearly. Acha, what is the question asking you? To find the market price. So what is the price if the coupon rate, for example, in this case, if you go to see sub point 2, the coupon rate over here is, I guess, 7.5% unless given otherwise. This is always assumed to be on a per annum basis. Remember, sir, how will we know this is per annum? Acha, if you have started your articleship and you see your bank FD rates, in whichever bank you have an account, if you open the bank FD rates, the rates are always given for as a percentage per annum. Whether you invest in a 6-month FD or a 2-year FD or a 15-day FD, the rate will be given as a percentage per annum number. So unless given otherwise, the rates as given will be a percentage per annum number. So over here, a bond with a 7.5% coupon, unless given otherwise, this is percentage per annum. Face value is 10,000, term to maturity is 2 years, and yield. So over here, your discount factor is 6% per annum. Okay, the term of this bond is, let us say, 2 years, and quite importantly, okay, the face value is, let us say, 10,000. Quite importantly, the interest is payable half yearly. Achha, the moment it becomes half yearly, we say that okay, 7.5% per annum equals how much? So over here, this is, let us say, just a second, over here 7.5% per annum will equal, let us say, 3.75% for 6 months. 6% per annum will equal 3%, let us say, for 6 months, whereas 2 years into 2 will equal to 4 half years. अच्छा, face value को into नहीं करके आने का, face value of 10,000 is face value of 10,000. Therefore, the value of the bond today is the present value of future cash flows. In this case, you know the future cash flows. Well, they will be, for example, 3.75% of 10,000, which means, I guess this will be what, 375 into the present value annuity factor at the rate of, let us say, 3% for 4 half years. Okay, plus you are going to get 10,000 back into the present value factor at the rate of 3% for the 4th half year for a consistent working. 1 divided by 1.03, 1, 2, 3, 4. So this is 0.8885, I guess, and this is 3.7171, and hence this is 375 into 3.7171 m plus, this is 1393.91, and 10,000 into 0.8885 m plus, this is 8,885, and if I total this, this is approximately 10,278.91. So does this make sense to you? Well, yes, this is just a slightly different version of question number 5. It does make sense to me because the coupon rate over here is 7.5 and the market rate is 6%. So the coupon rate is greater than the market rate, and as a result, your answer has to be greater than the face value. So if I verify this, in the first subpart, your answer is 99.1. In the second subpart, it is 10,278.91. This is exactly what we have got, and hence that takes care of your question number 6. Okay. We will go to the next question, that is question number 7. Let us read this question. Today being 1st of January 2019, so Happy New Year ka day hai. On 1st January 19, Ram is considering to purchase an outstanding corporate bond having a face value of 1,000. So, this bond already outstanding. Okay. So, this is a bond which has already been issued sometime in the past. That was issued on 1st January 17. अच्छा, उसमें से 2 साल हो गए. Remember, value of a bond is the present value of future cash flows. With 9.5% annual coupon and 20 years of original maturity. Achha, out of which 2017 is done, 2018 is done, and hence I think 18 more years are remaining. That is maturing on 31st December 2027. I think this is then 10 years of original maturity. Just make it 10. So we can say that there are the bond is 10 years, which is I think 1st of January 2017 and maturing on 31st of December 2027. This is not even 10 years. I think this is 11 years. What is happening? So over here, this is 11 years. I think this is ICAI is also printed in a similar way, but nevertheless, let us say you look at the exact dates. Final answer 11. So, and 11 years of original maturity, that is maturing on 31st of December 2027. No, there is no further change. Since the bond was issued, interest rates have been on a downside and it is now selling at a premium of 125.75. So, this is selling at a premium. What is the face value of the bond? 1000 and it is selling at a premium of 125.75 per bond, which means it is selling at, let's say 1000 plus 125.75, that is 1125.75. This is the market price. They have not given you the market price directly, they have given it to you indirectly. So this is 1000 with a premium of 125.75. So today's market price, if Ram is considering to purchase the outstanding bond, if he decides to ultimately go ahead and purchase a bond, he will have to pay 1125.75. Okay. Determine the prevailing interest on similar type of bonds if it is held till maturity, which shall be at par. So they are trying to figure out what is the rates. So if you look at this question, question number 7, this is on let us say the face value given to you as 1000. The market price on 1st of January 19 will be 1000 plus 125.75. So this is 1125.75. The coupon rate on this bond, I think, is given to you as, where is this? Is given to you as 9.5%. And now comes the maturity. So over here, your original maturity seems to be 11 years. However, for Ram, is he going to get the cash flows for 11 years? No. You will look at the remaining maturity. The remaining maturity over here will be 11 years, and out of these 11 years, 2 years have already gone by. The years 2000 and I think 17 and 2018, 2 years have already gone by, and hence you still have 9 more years remaining. So the remaining maturity, let us say, is 9 years. Okay. The remaining maturity is, let us say, 9 years. Perfect. Okay, next, determine the prevailing interest rate on similar types of bonds if they are held till maturity. So, what is the rate of interest over here will be treated as the opportunity cost across the market. If they are held till maturity and where redemption is happening at par, so redemption value is also 1000. Acha, now what do we want to do? What is the rate of interest prevailing in the market today? So if Mr. Ram were to buy this bond today, his cash outflow today would be 1125.75. So over here, you will have PVCO, present value of cash outflow. This is basically your initial investment. Your PVCO will be your initial investment. Let us say on 1st of January 2019, this will be 1125.75. Okay. Against this, there will be certain PVCI, present value of cash inflow. How much is the cash inflow that you are going to get? 9.5% into 1000, that is 95 in each year. For how many years? Sir, 9 years. Acha, but so you are going to get 95 into the present value annuity factor at a particular rate for a period of 9 years, plus you are also going to get the face value back. Redemption is happening at par, 1000. At the rate, some rate at the 9th year. Now the question arises, what are the rates to be taken? Now usually you will have to find such rates. However, if you look at question number 7, this is an institute question where they have given you present value factors at the rate of 6% and then at the rate of 8% for all the 9 years. So what you can do is you can even take the total values over here. This is 0.943 plus 0.890 plus 0.943 plus 0.89 plus 0.84. Remember, whenever rates are given, you have to take the rates as given by the institute. You will not say this is 3 decimals and 2 decimals. Whatever is the rate given, you will take 0.792, 0.747, 0.705, 0.665, 0.627, 0.592. So this is, I think, 6.801 if I'm not wrong, and 0.926, 0.857, 0.794, 0.735, 0.681, 0.630, 0.583, 0.540 and 0.5. I guess this is 6.246. So let us try to verify this. 95 into 6.801. Let us say at trial and error you are starting at 6%. So how did we select 6%? The two rates given in the question. So this is at 6%, and at the end this is 0.592. Okay. So over here this is, let us say, 95 into 0.6801, 95 into 6.801, this is 646.095 plus 1000 into 0.592 m plus, this is 592, and hence if I total up, this is 646.095 plus 592, which is 1238. Let's say 1238 point, let us say you can make this as 0.1, let us say over here, okay, 0.10. So over here this is at 6%. So is 6% the IRR? The answer is no, it is not the IRR, because at IRR the present value of cash outflow equals the present value of cash inflow, which it does not over here, and hence you have to take some other rate. Now which rate to take, whether you go up, whether you go down, all of this also has to be thought of. But in this case, first we are step by step. First we will go to understanding how the interpolation happens and then figure out from 6 should you go to 8, should you go to 4. In this case you have been given 8, so you go to 8. So this is, let us say, at 8%. Over here we will say 95 into present value annuity factor at the rate of 8% for a period of 9 years plus 1000 into the present value factor at the rate of 8%, let us say, for the 9th year. This is 0.500 and this is 6.246. I guess 6.246. I hope this calculation is correctly done. 95 into 6.246 m plus, this is 593.37 and 1000. So this is, let us say, 500, and hence I guess this is 1093.37. Aja. So if you go to see over here, there are certain working notes, but then we have said 1238.1 and 1093.37. So these were the two numbers. Now pay attention, this is something that you've done in your inter CA. Maybe you might have done it using a different method as well. Whatever method you do, you can follow, there's no problem. So at 6% the value is 1238. At 8% the value is 1093, which means your desired value is 1125. 1125.75. So your desired value is somewhere in the middle. Ideally the exact rate is the rate when the present value of cash inflow should equal to 1125.75, but you are not going to be as fortunate to get exactly 1125, and as a result you use a process which is called as interpolation. Interpolation honestly is just a sophisticated name for cross multiplication, where the process that we do over here is we will say by interpolation by interpolation, on the left hand side we will take the desired rates. Let us say your desired IRR is X. So X minus, so let us say this is always going to be higher rate minus the lower rate. So X is your desired rate minus, let us say, the lower rate. Between 6 and 8, what is lower? Sir, a very difficult question. Between 6 and 8, 6 is lower. Minus 6% upon, between 6 and 8, what is higher? Sir, 8% minus 6%. Okay. So as we say, this is higher rate minus a lower rate. Okay. Remember, this is just a basic mathematical process. Equals, on the RHS, what you will say? Well, you will take the present value factor at X. If X was the final answer, your PVCO should be your equal to your PVCI, which is 1125.75. So this should have been 1125.75. At 6%, you have got let us say 1238.10, 1238.10 divided by in the denominator at 8%, your present value is 1093.37 minus at 6% corresponding apples to apples. This is at 1238. Sir, what is happening here? Well, what we are doing is, if the gap between 8 and 6 is 2%, when the gap is 2%, the present value changes by, let us say, this difference. Then if the gap is how much for you to get your final IRR? So we will see this over here. Let us say this is x minus 0.06 upon 0.08 minus 0.06, which is on the left hand side you get 1125.75 minus 1238.1. So this is a negative 112.35, a negative 112.35 upon 1093.37 minus 1238.1. So this will almost always be negative only. The way the formula is structured, this will be negative. But if you are aware, a negative and negative will get cancelled, and therefore this is x minus 0.06 in the denominator. This is 0.02, and then you will say, okay, negative and negative gets cancelled. So this is 112.35 upon 114.73. Therefore you can take this on the other side. So you will say x minus 0.06 equals 112.35 upon 114.73 into 0.02. So we are trying to say, you can now take 0.06 on the other side. So we are saying that the rate is 6% plus something. But how much? Well, if the percentage is changes by 2%, if the percentage changes by 2%, cross multiplication, this is nothing but a cross multiplication. What is happening over here is, you are saying that if the percentage changes by 2%, that is 0.02, the present value changes by approximately 114.73. एक सेकंड, बराबर किया है कि नहीं बराबर नहीं किया है. 1125.75 minus 1238.1 and 12 perfect, and this is 1093.37 minus 1238.1, 144.73. Ajay, so what does the cross multiplication say? Cross multiplication says that if my present value changes by 144 when my discount rate changes by 2%. But do I need to change my present value by 144? No, I don't need to change it by 144. I just needed to change it by 112. So if my present value were to change by 112 rupees, if my present value were to change by 112 rupees, then my discount rate should change by how much? So therefore, I'll just continue this over here. This is x equals 0.06 plus, let us say, 112.35 upon 144.73 into 0.02. This is, let us say, 0.0155, and hence this is 0.0755, that is 7.55%. If you have the time, you can take 7.55% and find the present value annuity factor. It will be a number which is very, very close to 1125. So basically, in today's terms, what is happening is, if Mr. Ram purchases a bond today by paying, let us say, 1125, he agrees to get 95 in each year, and then at the end of the 9th year 1000, then in today's terms he is actually locking in a return of 7.55%. So if that is based on the market price today, that is what the market is happy getting. So the market rate of interest for this bond as well as similar bonds of a similar grade should be 7.55%. So over here, if you go to see, what do you do? Interpolation. So this is the first time where we do interpolation. You need a little more practice. Interpolation is the lower number and the higher number comparison. So on the LHS, you will take higher number minus lower number in the numerator, again higher number minus lower number in the denominator, and then on the RHS, you will take the corresponding present values. Then let the mathematics do the rest, and you will get the final answer, which will be 7.55. The prevailing interest rate on similar bonds will be 7.55%. Reference note, we usually infer the starting point using the approximate YTM calculation. Here we have not done that. This is the first question. However, in this case, The question has given us the rates to be used that is in the table, and hence we have taken the same directly. Okay, so in the beginning you have a reference note. In this question we have been asked to find the prevailing interest rate on similar types of bonds. This should be the market rate of interest. The market rate of interest can be inferred from the YTM that an investor can earn if he were to invest in the outstanding corporate bond today. The return on the corporate bond, that is YTM, should be the same as the return earned in a similar type of bond using the opportunity cost concept. Okay, so this takes care of question number 7. I would rate this as important for you to help it as a base for the present value calculation. Okay, sir, now that we have done a bit of interpolation, let us say you were at 6% and you were not given whether you go towards 8 or you go towards, let us say, 5 or 4. Then remember, there is a very important mathematical relationship. The present value and the discount factor, they always have an inverse relationship. Sir, how is it possible? How are they having an inverse relationship? For example, if let us say the cash flow was 100 and the discount factor was 10%, then the present value would have been, let us say the cash flow at the end of the first year is 100, then your present value would have been, let us say, 100 upon 1.1, this will be 90.9. Perfect. However, if the discount factor, let us say, goes from 10 to, let us say, 15%, or it goes from 10 to, let us say, 5%. As you can see, if it goes from 10 to 15%, my value will be 100 divided by 1.15, and hence if it is 100 divided by 1.15, this will be 86.9. Whereas if it goes to 5, this is 100 divided by 1.05, so this is 100 upon 1.05, discounting for 1 year, so this is 95. So basically what is happening over here is, when the discount factor, so how was 90.9 calculated? So 90.9 was calculated as, among other things, this was calculated as 100 into, let us say, 1 upon 1.10 or 100 divided by 1.1 discounted. So this was 90. Now if this was at a discount factor of 10%, so as the discount factor increased, as you see, the present value went down. So when you went from 10% to 15%, the present value, mathematically, there is no rocket science, it is mathematics. Why? Because you are increasing the denominator. Discount factor is going to come in the denominator. If you increase the denominator, the value will fall. To be honest, you can't really, it's mathematics over here, and hence earlier you were doing 90 into 1 upon 1.1. Now instead of dividing it by 1.1, well, you are dividing it by 1.15, so you are increasing the denominator. Whenever you increase the discount factor is not compounding, it is not multiplying, it is dividing, and hence if you increase the discount factor, that is, you increase the denominator, the present value is going to fall. Okay, and hence you can see over here that the rate goes, so there is an increase in the discount factor, the rate goes from 90 to, let us say, the present value goes to around 86, which means there is a fall in the present value. On the other hand, when you go to the other case, where the rate over here goes from 10% to, let us say, 5%. So there is a fall in the discount factor. That means there is a fall in the denominator. Numerator remaining constant, if the denominator reduces, there is going to be, let us say, from 90 you are going to go to 95, which means there is an increase. Basically, as you can see, there is an inverse relationship. Sir, what is the significance of this for the time being? Well, the significance of this inverse relationship is that in trial and error, in interpolation, if you are at 6% and your answer is 1238, as you can see over here, your desired target is 1125, which means over here you have to reduce the discounting. If you have to reduce the present value, you have to go and find a number which is greater than 1125, which you have, and then a number which is less than 1125. So over here, if you want to reduce the present value so that it comes to 1125, if you want to reduce the present value, well, you will have to increase the discount factor. You will have to increase the discount factor. On the other hand, if you had started at 8% and you got 1093, in which case you have to reach 1125, which means you have to increase the present value. If you have to increase the present value, opposite, you reduce the discounting factor. And hence, as you can see, the rate from 8, you will go towards either 7 or 6 as the case. Maybe you can take a difference of 1 or 2%, that is fine. But that is an important relationship. Over here, the one thing that we had not read, if you remember the key point, there's an inverse relationship. You can focus on the screen for the time being on page 5. There's an inverse relationship between the price of the bond and the market rate of interest, which is a discount rate or the yield. That is, as the discount rate increases, the bond price, which is a present value, decreases, and vice versa. This understanding is going to help you going further when you go to a slightly more complex trial and error problem. Right now we are just kind of getting a sense of it. So we are done with question number 6, we are done with question number 7. Now we'll try to do question number 8. A few technical terminologies over here also that need to be addressed. Question number 9 is a very interesting and an important question. But before that, let us say you go to question number 8. Okay, let us read this. A hypothetical company ABC Limited issued a 10% debenture with a face value of 1000. So the coupon over here is 10%. The face value over here is, let us say, 1000. Okay, of the duration of 10 years. So the term over here, let us say, is 10 years, and it's currently trading at 850 per debenture. Excellent. So you have the market price also given as 850. The bond is convertible into 50 equity shares being currently quoted at rupees 17 per share. So if you convert the bond, you will get 50 shares, each share being worth 17 rupees. That is fine. If the yield on an equivalent comparable bond is 11.8%, okay, then calculate the spread of the yield of the above bond from the comparable bond. Sir, what is written over here? It is written that the yield on an equivalent comparable bond is 11.8%. So a comparable bond will have 11.8% return. Calculate the spread. Spread is a technical word for difference. Spread means the difference. Calculate the spread, that is, calculate the difference of the yield of the above bond from the comparable bond. Sir, we can assume that the above bond is also having a yield of 11.8%. Sir, why do you want to assume it? You can calculate it. You have the data about the face value, you have the data about terms, you have the data about the market price, you have everything, which means you can actually find the yield to maturity. And to spoon feed you further, you have been given the relevant present value factor tables. The relevant present value factor table is as followed: for the present value factor at the rate of 11%, and then the present value factor at the rate of 13%. This goes on for 10 years. I think there are 10 more years to remain. So basically, instead of directly asking you to calculate yield to maturity for a bond issued by ABC, the question asks you in a very indirect and a tricky, this is financial jargons, they try to scare you. Jargons means technical words. Calculate the yield, the spread, what have you studied? Basically, what do you want to find? You want to find the spread, that is the difference between the yield to maturity of the ABC bond and the yield to maturity of a comparable bond. So you have the yield to maturity of a comparable bond, which is 11.8%. which means if you somehow find this yield to maturity of the ABC bond, you will be able to find a spread. So the question is basically wanting you to find the yield to maturity of the ABC bond. How do you calculate the yield to maturity? Well, the rate at which the present value of cash inflow will equal to the present value of cash outflow. Okay. So when I look at question number 8, if you want, you can just pause the video and try on your own. I would love if you do that. It's fine if you make a mistake. Again, in this question, you have the rates in front of you. Maybe you have to interpolate between 11 and 13. The two rates are given to you. If institute gives you rate, you have to interpolate between those rates only. If it gives you the factors, you will have to take those factors only. So please try to find the YTM on your own, if possible, over here. And then we can probably, if you go to more complex question, you will be able to tackle it better. Chalo. So over here, question number 8, if you have tried well and good, otherwise, you want to find the YTM on the ABC bond. You want to find the YTM on the ABC bond. Sir, how will we do that? Well, we will try to find the present value of cash outflow. if an investor initially invests in ABC bond, what is the initial investment that he will make? Sir, it is 850. In return, what is the cash inflow he will get? Well, he will get a cash inflow of 10% of 1000, that is 100, in each of the 10 years, and at the end the redemption I think is happening at par unless given otherwise, and as a result this will be 1000. So this is, let us say, at, sir, which rate will you take? 11% hypothetically. How did you come to 11? The question had given you. In the questions going further, question will not tell you. So you will have to figure out the starting point, and we will see how to figure out that starting point. So over here at 11%, we will say this is 1000 into, let us say, 10%, that is 100, into the present value annuity factor at the rate of 11% for 10 years, plus 1000 into the present value factor at the rate of 11% for the 10th year. Acha, is the data available? Yes, this is 0.352, and for the first 10 years it should be what? Well, if I take the totals over here, 0.901, 0.812, 0.731, 0.659, 0.593, 0.535, 0.482, 0.434, 0.391, 0.352, and hence I guess this is 5.89. So over here this is into 5.89, so this comes to, let us say, if I take this, this comes to, let us say, 100. So this is 589 plus 352, 941. Acha, now the question has given you the subsequent rates, but ideally your target is 850, and hence ideally you would want to reduce the present value. If you want to reduce the present value to come close to 850, you will have to increase the discount factor, and hence the next discount factor, as you see over here as given in the question, is 13%, and hence you will take 100 into the present value annuity factor at the rate of 13% for 10 years, plus 1000 into the present value factor at the rate of 13%, let us say, for the 10th year. So the number that is given over here is 0.295, and if I take the total, 0.885, 0.783, 0.693, 0.613, 0.543, 0.480, 425, 376, 333, 295, and hence I guess this is 5.426. So over here this is 5.426, and this is into 0.295. So if I multiply this, this is what? 542.6 plus 295 comes to 837.6. So over here basically mission accomplished. You have one number which is above 850, one number which is below 850, which means none of them are equal, which means your actual number is below 13% but above 11%, somewhere in the middle, and hence for doing that you employ a process called as interpolation. Here I would definitely want you to try this on your own. Once you do this sum, you will have a slightly better understanding, and then it will flow naturally to you after a couple of questions. So when we do interpolation, if you do it on your own, best you can pause the video as well. So this is x minus, so x minus the lower number between 11 and 13. 11 is a lower number upon higher number, that is 13 minus 11. Okay, on the right hand side you will take the corresponding present values. If x was the accurate answer, PVCI will equal PVCO, and hence your answer will be 850. But at 11%, this is 941, and in the denominator this is 837.6 minus again 941. Therefore you will have x minus 11%. Percent means per 100, and hence this is 0.11, this is 0.13 minus 0.11. So this is, let us say, 850 minus 941, it's a negative 91. 837.6 minus 941, it's a negative 103.4. Negative and negative will get cancelled, therefore x minus 0.11 equals, you will say, or upon 0.02 equals 91 upon 103.4. Therefore x minus 0.11 equals 91 upon 103.4 into 0.02. So this is basically a cross multiplication where if I'm starting, let us say, at 11 and I have to go towards 13, I will say that if I move from 11 2 percentage points up, my present value will change by 103.4, but I don't want to move by 103.4, I just want to move 91, which means how much will that be? So therefore x is equal to 0.11 plus, over here the cross multiplication, 91 upon 103.4 into 0.02, so this is plus 0.0176, and hence this is coming to 0.12, I guess, that is 12.76%. So the yield on the YTM on the ABC bond is basically 12.76. However, the YTM on a comparable bond is basically 11.8. Ideally, they should be the same. If they are different, maybe you can investigate the reasons. In practice here, they have not asked you, or not, neither have they given you the data. So if I want to find the spread between the two, that is 12.76 minus 11.8, and hence this comes to approximately 0.96%. This will be the spread in case of question number 8. If you go to see, this is interpolation and all of this, yes, 0.96% is the spread. Okay. After this, the question that you do is question number 9, which I would say is very important. This is probably the most important question from all the questions that we have done till now. So if you have to revise a single question, I mean, we have marked a couple of other questions as well like important. So that's question number 3, question number 4, question number 5, question number 7. There's also question number 9, which is important. Okay, so let us read this question. Okay. So based on the credit rating of the bonds, Mr. X has decided to apply the following discount rates for valuing bonds. So this is based on the credit rating. Sir, what do you mean by credit rating? There are companies like CRISIL, ICRA, Fitch, etc., which give ratings of the bond. Usually AAA being the best, followed by AA, then A, then BBB, then BB, then B, then C, and then last being D. So higher the rating, less is the risk of default, and hence lower is the interest. However, lower the credit rating, higher is the risk, and there's a higher possibility of default, and hence if you have to give a loan to a person who has a high possibility of default, you will have to charge a higher rate of interest to compensate for the higher risk. So this is very logical. Based on the credit rating of the bonds, Mr. Z has decided to apply the following discount rates for valuing bonds. So the credit rating and the discount rate. If your credit rating is AAA, then you have 364-day treasury bill plus a 3% spread, yani let us say the treasury bill rate, T-bill is the treasury bill, which is the government bond. So if the treasury bill rate, for example, is let us say 10%, then we will say, okay, on a government bond we will be expecting 10%. You may be AAA rated, but you are relatively more risky than the government. Government can print the currency, and hence government technically will not default, at least on local currency debt. And hence you will have 364 days plus treasury bill rate, that is a government bond rate, plus 3%, which means then you will be let us say requiring 13%. So this is 10 plus 3, for example, if the 364-day treasury bill was 10% rate. AA bond is AAA plus 2% and single A bond is AAA plus 3%. Okay, he is considering to invest in a AA rated bond. So okay, so the relevant bond for us is a AA rated bond, and hence the required rate of return would be the required rate on a AAA rated bond plus a 3% spread, plus a 2% spread. 1000 face value bond currently selling at 1025. So this is given to you as the market price. This is currently selling at 1025. Okay. The bond has 5 years to maturity, and the coupon rate on the same bond is 15% per annum and is payable annually. Okay. So over here, if you look at a AA rated bond that you are evaluating, The coupon rate over here is 15%. The term of this bond is 5 years. Face value is 1000 and the market price is also given. Market price is 1025.86. Okay. The next interest payment is due 1 year from today and the bond is redeemable at par. So face value is also equal to the redemption value. Assume the 364-day treasury bill to be rate to be 9%. So this is a rate of a risk-free bond or a government bond. This is 9%. You are required to calculate the intrinsic value of the bond. Sir, what do you mean by intrinsic value of the bond? The value of the bond based on its future cash flows. This is the value of the bond considering the present value of all the future interest payments. Intrinsic value of the bond for Mr. X. Should he invest in the bond? Okay. Also calculate the current yield and the yield to maturity of the bond. So this is a question which covers everything. It first requires you to find the intrinsic value. Sir, but we have been given the price at 1025. Yes, if nothing was given, the market price will be the same as intrinsic value. However, here you have been given the term, you have been given the coupon rate, you have been given the required rate of return. Everything is given, and hence you will try to find the intrinsic value based on the fundamental factors. You will say, okay, whatever be the market price, what should be the value I should be ready to pay? So over here, this is a very important question. Question number 9. So what is the required rate of return? Required rate of return on a AA rated bond. The required rate of return on a AA rated bond is the 364-day treasury bill rate plus a 3% spread, which means this is going to result in the rate that you require for a AAA bond. So the 364-day treasury bill rate will be 9%, to which you add 3, and hence 12% will be the required rate of return on a AAA rated bond. But is a bond that we are considering a AAA rated bond? No, it's a AA rated bond, which is basically AAA rated bond plus a 2% spread. That is a difference, which is 12%. Plus 2, and hence finally you get 14%. Usually this rate was given to you from question 2 all the way up to question 5. This was given, but if this was not given, how would this be derived? Well, this is a very good thought process. The intrinsic value of a bond, remember, is the present value of future cash flows. The market price is given, but well, sometimes you have to take a decision whether this bond is worth buying or not, for which you have to compare the market price to some number to figure out whether the bond was worth buying or not. So based on the cash flow features of the bond, the coupon rate is 15%. 15% of 1000, and hence the coupon is, I think, 150. 150 into the present value annuity factor at the rate of 14%, which an investor requires. Over here, if you go to see conceptually, your coupon rate is 15, market rate or the required rate is 14, and as a result, over here, this will be a premium bond. It is a superior bond. The bond gives you 15 when the required rate is 14, and hence you should be willing to pay a premium. Your answer should be greater than 1000. 14% for a period of 5 years plus the bond redeems at par. So 1000 into the present value factor at the rate of 14%, let us say for the 5th year. Over here, the discount factors have not been given. So finally, you will have to do some calculations. 1, 2, 3, 4, 5. So this is 0.5194, and grand total over here will be 3.4331, and hence this will be 150 into 3.4331 m plus 514.97 plus this is 519.4 plus, let us say, we'll have 519.4 m plus MRC, and hence this is 1034.37. So intrinsic value should be 1034.37 in an efficient market, in a fair market. That should be the same as the market price. So the question asks you to calculate the intrinsic value. We are saying 1034.37 0.37 will be the intrinsic value. However, what is the market price? Should you invest in the bond? So over here, let us say first is the required rate of return, intrinsic value. Now you compare the intrinsic value IV, which in today's terms you are prepared to pay maximum 1034.37. Intrinsic value is the present value of future cash flows. So based on the future cash flows that you are going to get in today's terms, maximum you are ready to pay 1034. However, the market price, the bond is available at 1025.86. You are ready to pay 1034. Will you pay 1034? No. If it is available in the market at 1025, should you buy it? Yes, you should grab it because you are ready to pay 1034 for an asset which is available actually at 1025, and hence the asset is available at a cheaper price. Such assets are called as undervalued. In a fair market, your intrinsic value is 1034, your market price should also be 1034. So what will happen practically is more and more investors will detect this opportunity and they will keep on buying this bond, and hence the demand for the bond will increase and it will go up and reach probably 1034. And this is why your role as a bond manager, as a financial or portfolio manager is important, because your idea is to spot such opportunities before they are available to the public at large beforehand. So over here, the intrinsic value is greater than the market price, and hence this bond is worth buying because it is undervalued. Its true value is actually 1034, but it is quoted at around 1025. It is undervalued and hence should be purchased. Should he invest in the bond? The answer is yes. In fact, he should buy this bond. Also calculate the current yield and the yield to maturity. So over here, if you have to calculate the current yield, I think this is going to be easy. Yield to maturity will be a bit of a problem. So current yield will be calculated as interest upon the market price. Achha, now the question is, in the denominator, what will you take? Will you take 1025 or will you take 1034? Because before this, in every question, you thought that the markets are efficient, and since data was not given, we would always consider that the market price is the same as the intrinsic value. But in this case, that is clearly not the case. So your interest over here will be, let us say 1000 ka bond hai into a coupon rate of I think 15%, which means your interest will be clearly 150 for the current yield. But in the denominator, what should you take? Should you take the intrinsic value, that is 1034, or should you take the market price, that is 1025? Think and answer. Sir, we will take the 1025 number because that is what we are actually investing. In today's terms, we are investing around 1025.86. Let the intrinsic value be 1034. Are you investing 1034? No. That is the maximum amount you would have invested in order to get a 14% return, but the market price is 1025, so you will write a check for 1025, and yield, that is a measure of return, is based on the return on investment. So if your investment is 1025, what are you getting in return? You are getting 150, and hence 150 upon 1025.86 into 100. So this is probably 14.62%. So this will be, let us say, 14.62%. This is what you call as the current yield. This will be 14.62%. Okay, so as we see over here, your current yield is 14.62%. Is the question ended? Not yet. So this is, let us say, the yield to maturity. This is the last part. So yield to maturity is a rate where the present value of cash outflow equals the present value of cash inflow. Again, what will be your initial investment? Sir, it will be 1025.86. Sir, the intrinsic value is 1034. Let it be. You will invest 1025.86. You will start at the present value of cash inflow. Achha, at what value will you start? Well, to start with, you have already done a working at 14%. At least in this case, you have done a working at 14%. So you say at 14%, the value is 1034. You don't need to do it again. 1034.37. Again, in this question, you have been given you have done a working at 14. So this is 1034.37. This is calculated in the intrinsic value calculation, basically at 14. So is your yield to maturity 14? No, because if it was 14, the present value of cash inflow will equal to the present value of cash outflow. Now at 14%, your present value comes to 1034. So what do you have to do? Sir, I have to reduce the present value. If I have to reduce the present value, remember there is an opposite relationship between the present value and the discount factor. If I have to reduce the present value, well, I'll have to increase the discount factor. So from 14, where will I go? Let us say I go to 15%. I want to reduce the present value, so I need to increase the discounting factor, which means at 15%. If I do the workings over here, this will be 150 into the present value annuity factor at the rate of 15% for a period of 5 years plus 1000 into the present value factor at the rate of 15% for the 5th year. That's 1 divided by 1.15, 1, 2, 3, 4, 5, 0.4972 and 3.3522. And hence if I multiply this is 150 into 3.3522 m plus, that's 502 point something 83, and 1000 into 0.4972 m plus MRC. So this is, let's say, 497.2, and hence it comes to 1000. Sir, even if we did not do this 1000 calculation, even if you thought through, this should have been 1000. Sir, why? Because at 15%, your coupon rate is also 15, your discount rate is also 15. Remember, at the beginning of the class, we had discussed, whenever the coupon rate and the discount rate are similar, whenever the coupon rate and the discount rate are fairly close to each other, your market price can kind of be considered to be equal to the face value. So over here, well, do I need to do further calculations? No. My target is 1025. At 14%, it is 1034. At 15%, it is 1000, which means it is somewhere in the middle, and hence you will have to do interpolation over here. So this is by interpolation. By this stage, you should be comfortable with interpolation. You will say x minus what? Sir, the lower number upon higher number, which is 15, minus a lower number, that is 14. So at x, you need 1025.86 minus at 14, you will have 1034.37, divided this by 15%, which is at 1000, minus 1034.37. So if you do this working, this is x minus 0.14. You can even do it slightly faster. I'll directly show a 0.01 over here. On the right hand side, there's a negative number of 1025.86 minus 1034.37. That's 8.51 negative divided by 34.37 negative. Therefore, x minus 0.14 equals, you'll say 8.51 upon 34.37 into 0.01. Remember, this is more of a mathematical concept, less of a financial concept. It is just a cross multiplication. Therefore, x is equal to 0.14 plus minus and minus will get cancelled, 8.51 upon 34.37 into 0.01, 0.0025, and hence this is 0.1425, that is 14.25%. So your minimum required rate of return, it is like saying in your inter CA, your NPV, you minimum require your cost of capital, but your IRR can be sometimes higher. So your minimum required rate of return is 14%, but you are actually making 14.25% over here because the bond is available cheaper. It is available at 1025 instead of 1037 or 34. If it was available at 1034, we would have made a 14% return. Here you are making a 14.25% return. So we will just verify this. Your intrinsic value is 1034. Recommendation, you should buy the bond as it is cheaper. 14.62 is the current yield and 14.25% is the yield to maturity. So this kind of covers a majority of what we have done in today's class. So please ensure that you read this properly. Aja. Then there is question number 10. This is linked to the concept of duration, and hence we will not be able to do this right down. So this is on duration. We'll do it along with bond risk. Next, you will go to question number 11. Okay. On 31st March 2013, the following information about the bonds is available. So there are 4 bonds. First, there's a zero coupon bond. Face value is 10,000. Acha, when is this information available? This is the information which is available on 31st March 2013. Okay. Zero coupon bond which has a face value of 10,000. Maturity date is 31st March 2023. Acha, which means I guess this is 10 years away. So a term, remaining term is, let us say, 10 years. And this is zero coupon, which means there's no cash flow. Coupon rate is 0, coupon date is not applicable. Achha, for this you will have the first sub point. If the 10 years yield is 7.5%, what is the price the zero coupon bond would fetch on 31st March 13? Well, the price is the present value of future cash flows. Over here, the future cash flows will be 0 rupees for the next 9 years, and then suddenly at the end of the 10th year, you get the entire 10,000 into the present value factor at the rate of 7.5% for 10 years. So this is 1 divided by 1.075. I think this is 0.4852, and hence the price will be 4852, I guess. So over here, if you go to see 4852, perfect. Acha, the second part of this question is to be done along with money market. So this is treasury bill to be done along with money market. At the end of this chapter, we will come back to this, a very simple part. So second part, we'll do it along with money market. This is not to be done now. Second, a 10.71% GOI 2023 bond with a face value of 100. Maturity date is 2023, so that is again 10 years away. 10.71% and coupon is paid every year. Okay, so this is, what do I have to do again? If the 10.71% GOI 23 bond having a yield to maturity is 8%, what price would it fetch on 1st April 23? So in a fair market, the yield, which is the return that I am getting, should be the base that I use for the purpose of discounting factor. Institute uses these words interchangeably. The yield, discount factor, required rate of return, market rate of interest, all of these are used interchangeably. After computation or after the coupon payment on 31st March. So over here, the value of this bond is the present value of future cash flows. So over here, if I look at question number 11, sub point 3, what are the future cash flows? This is 100 into 10.71%. That is 10.71 into the present value annuity factor at the rate of 8%. Over here, this is given as 8%. So your answer has to be greater than 100 in my understanding, because the discount factor is 8% and you are getting 10.71% for 10 years plus 100 into the present value factor at the rate of at the rate of 8% for the 10th year. 1 divided by 1.08. So this is, I guess, 0.4632 and this is 6.7101. So that is 10.71 into 6.7101, 71.87 and 46.32, and hence this is 118.19. Let us see if this does make sense. 118.19, your answer had to be greater than 100. Well, it is more than 100. And then the last part, sub point 4. It's again a 10% GOI 2018 bond with a 100 face value. 31st March 18 is a maturity date, so that is technically 5 years away. Okay. Coupon rate is 10. However, it is payable on 31st March and 30th September, and hence it is half yearly. So over here, your coupon rate is 10%. That is divided by 2, so you will take 5%. What is your required rate of return? On the next page, if the 10% GOI bond having a yield to maturity is again 8%, what would be the price that you would fetch on 1st April 13? Over here, your required rate of return is 8%. You divide it by 2 and hence that comes to 4%. Again, your answer has to be greater than 100 because this bond is a bond with the required rate of return of 8 and the coupon is 10. Again, the term over here is, I think, how much is the term? The term is 5 years. 5 years into 2 if I do comes to 10 half years, and that's it. So you will use this database and find the value. So the value today is the present value of future cash flows, which is, for example, 100 into 5%, that is 5 into the present value annuity factor at the rate of 4% for 10 half years, plus 100 into the present value factor at the rate of 4% for the 10th half year. So that's 1 divided by 1.04 0.6756, grand total 8.1109. So this is 5 into 8.1109 m plus, it's 40.55 approx, and 100 into 0.6756, 67.56 approx, and hence your answer comes to 108.11. So this is, let us verify this, this is 108.11, perfect. So that takes care of question number 11. Acha, question number 11, there is some extra part which you will not do it for the time being. We have not yet studied duration. Once we study duration, you can come to this point. Question 12 is fairly complex, so we'll keep it aside for the time being. We'll first get a fairly good understanding, and then this question number 13. So 13 is something that realized yield, we will do it once we are slightly more comfortable with logarithm tables. Otherwise you can try question number 13 right now. Chalo, let us read this question. Question number 13. A 5-year bond with an 8% coupon and maturity value of 1000 is currently selling at 925. What is its yield to maturity? So this is a standard question, okay? So what will you do in this case? So if you look at question number 13 over here, we will first have to find, let us say, the PVCO. So your present value of cash outflow is your initial investment. You have done multiple times over here, which is in this case 925. Now we'll have to compare this with PVCI. Now when we try to find the PVCI over here, you will have to start. But the problem is at what value will you start? And hence in such cases, in your rough, what you can do is you can try to find the approximate YTR by TM in order to find a starting point. We will say, okay, approximately this is interest, 8% of 1000, so that is coming to 80 rupees plus 1000 minus 925 upon 5 upon, let us say, 1000 plus 925 divided by 2. So this was the approximate YTM. Ideally you have to find the most accurate YTM, but you can calculate this approximately and say 75 is the total capital appreciation over 5 years, and hence on a per annum basis this is 15, and hence in the denominator this is 1000 plus 925 divided by 2, this is 962.5, and hence if I find this is what, 80 plus 15, which is equal to 95 divided by 962.5 into 100, and hence this is 9.87%, which means, you don't even need to show this to the examiner, but this will act as a starting point. You will know, like in the other questions you had some of the other guiding points. Here there is none, and hence we will say the closest to this is 10%. So let us start at 10%, in which case what is the coupon rate? 8%. So this is 80 into the PVAF at the rate of 10% for a period of 5 years plus at the end 1000 into the present value factor at the rate of 10% for the 5th year, in which case this will be, I think, 3.7908 and this will be 0.6209. You can do these workings, but this is 80 into 3.7908 m plus and 1000 into 0.6209 m plus MRC. So this is 924.16. So for all practical purposes, I would say this is almost equal to 925. For all practical purposes, you can say 10% is the YTM. However, if you want to be absolutely accurate, you will say, okay, you need a number between, so you need a number over here to be greater than 925. So you'll have to increase the present value. If you have to increase the present value, there's an inverse relationship. So you decrease the discounting factor. So you can say probably at 9%. So at 9%, this is 80 into 1 divided by 1.09 plus 1000 into 0.650 and hence this is, let's say, approximately 3.88 or 3.89 approximately, in which case this is 80 into 3.89 and 1000 into 0.65, and hence this is 961.2. So mission accomplished. We have one number above 925, one number below 925, and hence you can do interpolation. Interpolation is higher number minus a lower number. So this is x minus, let us say, 0.09 upon 0.10 minus 0.09 equals, on the RHS we'll have 925 minus, at 9% this is 961.2 upon 924.16 minus 961.2. For all practical purposes your answer is at 10%, but just for absolute academic accuracy, so you can say equals, this is negative 925 minus 961.2, this comes to a negative 36.2 upon 924.16 minus 961.2, this is 37.04. Therefore x equals 0.09 plus, this is upon 0.01, so this is 36.2 upon 37.04 into 0.01. So if you do this working, this is 0.09 plus 36.2 upon 37.04 into 0.01, so this is 0.0098, that is 9.98%. This is your yield to maturity. This is 9.98% for all practical purposes, that is equal to 10%. So over here, as you see, 9.98%. Also calculate the current yield. Current yield should be very easy. This is 80 divided by 925 into 100. It's 80 divided by 925 into 100, which is 8.65%. 8.65%. So realized yield, we will do this later once you understand the logs. So for the time being, we'll keep aside realized yield. Okay, so this is one thing which is to be done, but otherwise realized yield has never come in the exam in the past, so it's not as important. But first you need to get clarity over your regular questions. So 8.65% for the current yield and around 9.98% for the yield to maturity. I think there are just two more questions which is remaining over here. There's question number 14 and 15. When you look at question number 14, it is just a slight variation of the yield to maturity concept where tax rate is given. So whenever tax rate is given, you have to remember what you have to take is a post-tax cash flows. If you want to find a post-tax yield to maturity, the cash flows that have to be taken is the post-tax cash flows. Like when you make the investment, at that time there is no tax impact. However, when you receive the interest, that interest may be taxable. So if there is 10 rupees of interest and 30% is a tax rate, then post-tax interest is 100 minus, let us say, 30% of 10, that is equal to 7 rupees is a post-tax interest. And if you look at the redemption value, sometimes the redemption happens at a premium, sometimes it happens at par. If the redemption happens at par, that is the amount that you have invested is the same as what you are getting back, then there is no capital appreciation. However, if there is a capital appreciation element over here, then there will be a capital gains on that as well, and hence you will have to find the post-tax redemption value. The moment you find the post-tax interest, you find the post-tax redemption value, then the working becomes exactly the same. Okay, so the next you go to question number 14. Now there is a 9% 5-year bond issue in the market. Okay, the issue price is 90, so this is your PVCO, present value of cash outflow. You will have to spend 90, and the redemption price is 105. Okay, so there is possibly a capital appreciation of 15, 105 minus 90. For an investor with a marginal income tax rate of 30% and a capital gains tax rate of 10%, assuming no indexation, what is the post-tax yield to maturity? For this post-tax yield to maturity, you will have to find the post-tax cash flows. So what is your post-tax interest? Where we will get 9% of, let's say, assuming 100 is the face value. Assuming face value is, let us say, 100, you will say post-tax interest, for example, is 100 into 9%, which is 9, minus 9 into 30%. So 9 is your cash inflow for interest. However, on this 9 you will be charged tax of 30%, which is your cash outflow. So 9 into 30% comes to 2.7. So 9 minus 2.7, I guess 6.3 is the post-tax interest. Then you have to find the post-tax redemption value. Sir, how much is the redemption value? Well, this is 105. Acha, so 105 into 30% will be the tax. No. Tax is not levied on the redemption value. It is levied on the profit. So this is minus 105 minus 90. So this is your capital appreciation into 10% is the capital gains tax rate. So this is 105 minus, I think, 15 into 10%. So this is basically 105 minus 1.5 and hence 103.5. So what will happen over here is your investment is 90. There is no tax impact over here. So if you want to find the yield to maturity, all you have to do is you have to take the post-tax cash flows. So when we look at question number 14, we will say present value of cash outflow will be the investment amount, that is 90, and the present value of cash inflow will be, let us say, 6.3 and 103.5. Sir, but at what value will you start? Well, you try to find the approximate YTM. So your approximate YTMs in the exam, if you don't have time, you just do the approximate YTM and proceed. Your marks will be deducted. However, something better than nothing. So this is your interest, which is, I think, 6.3 plus 103.5 minus 90 upon 5 upon 103.5 plus 90 divided by 2. So this is 6.3 plus 13.5 divided by 5, which is 2.7 upon 103.5 plus 90 divided by 2, which is 96.75. So this is basically, I think, what, 9 divided by 96.75 equals 9.3%, which means it is closest to 9, and hence you will start at 9%. So at 9%, 6.3 into the present value annuity factor at the rate of 9% for a period of 5 years would be, I think, 1 divided by 1.09. This is approximately 3.89 rounded off, and at the end you get 103.5 into 0.650 again rounded off. So if I do this working now, 6.3 into 3.89 m plus and 103.5 into 0.65 m plus, I'll get approximately 91.78. Acha, my target is 90, which means I need to reduce the present value. If I need to reduce the present value, I need to increase the discounting factor, which means from 9 I'll have to go towards 10. Okay, so at 10 this is 6.3 into, let's say, 3.7908. Remember, these are present value factors, you can calculate them as well. I'm just focusing on the main concept base. Less over here. Okay, add over here, let us say 6209. So this is 6.3 into 6.3 into 3.7908 and 103.5 into 0.6209, and hence the total is 88.15. Perfect. Mission accomplished. We have one number above 90, one number below 90, and hence you can do interpolation, that is x minus the lower number, that is 9, upon the higher number minus the lower number, and hence on the right hand side on the right hand side you will have x pe answer is 90 minus 9%, answer is 91.78 upon 88.15 minus 91.78. therefore x upon, okay, let's do it in a stepwise basis, x minus 0.09 upon 0.01 equals a negative 1.78 upon 88.15 minus 91.78, which is 3.63. Therefore x equals 0.09 plus 1.78. this will become negative, negative becomes positive, 3.63 into 0.01. This is 1.78 upon 3.63 into 0.01. 0.0049, that is approximately 9.49%, will be the post tax yield to maturity. All you have to do is, in order to find the post-tax yield to maturity, you will take the post-tax cash flows, and then ultimately if you do this working, comes to around 9.49%. And I guess we'll go to the last question for the day, which is question number 15. This by and large covers a lot of concepts on yield to maturity. So let us quickly wrap up question number 15. An investor is considering the purchase of the following bond. Face value is 100, coupon rate is 11, and maturity over here, I'm sorry, the most important number, 3 years. Maturity is 3 years. If he wants a yield of 13%, what is the maximum price he should be ready to pay? Well, that is the present value of future cash flows. So over here, one would say that, well, in this case, he will pay, let us say, coupon of 11 into the present value annuity factor at the rate of 13%. 1 divided by 1.13, 1, 2, 3. This is 2.3612 and 100 rupees into, let's say, 1 divided by 1.13, 1, 2, 3. This is 0.6931, and hence 11 into 2.3612 and 100 into 0.6931. If you total up, this is 95.28. 95.28. Perfect. So you should be 95.28. If you do that, well, you are going to get 11%. Sorry, you are going to get 13% return. If the bond is selling at 97.6, so this is the market price, what would be his yield? Well, if it is selling at 97.6, if I were to invest, my PVCO would be 97.6. PVCI, well, I will start, let us say, at 13. If I start at 13, my value is 95, which means I need to reduce the present value. That means, no, sorry, I need to increase my present value to go from 95 to 97. So I need to increase my present value. So I need to reduce the discounting factor. So let us say I start at 12%, in which case this will be 11 into, let's say, 1 divided by 1.12. So this is, I think, 2.4018, and then 100 into 0.7118. So if I total this, this is 11 into 2.4018 M plus 100 into 0.7118 M plus MRC. Perfect. You get, coincidentally, you get 97.6, which means, do I need to do any interpolation? No. Now you might be requiring, let us say, 13%. However, if the price today is 97.6, what you will get at the end is 12%. If you want, I mean, you might not buy this bond, but the yield, if you want to calculate, is actually 12% in this case. So this takes care of these questions. So I would strongly recommend that whatever is done, you ensure that you revise all of these, practice at least 1 or 2 questions on this on pen and paper. And tomorrow we'll continue further. In our next class, we'll go further to more complex concepts in bonds. We'll have a lot of fun. Let's stop for the day, and I'll see you tomorrow. Have a good day. Bye bye. Take care.